for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Live from New York City this morning. Good morning to you all. A tough morning so far for the equity market, down about 0.75% on the S&P 500. On the Nasdaq 100, down a little more than 1%. We'll talk about Tesla a little bit later. The stock not doing too well this morning off the back of earnings yesterday. Margins taking a hit. I think that's inevitable after the price cuts we've seen over the last several months. Inventories climbing a little bit higher, and Lisa, seemingly no end to the push maybe to go for volume over profitability.
Which is an issue in and of itself, because this means that their profit margins are probably going to contract even more. This morning we are going to get a series of earnings from also banks, smaller regional banks, and we'll get a sense of how much their margins are really contracting. This is sort of the margin compression people have been waiting for on every level. Tesla very much front and center with us.
Fifth Third out right now. So the first quarter for provision for credit losses, here's the number for you, $164 million. The estimate 180.6, so a touch lighter than expected. One measure of net interest income coming in at $1.52 billion, the estimate 1.54. So let's say that's in line. The net interest margin comes in at 3.29%, the estimate 3.32. Lisa, what else do you see here?
Well, I'm looking also at KeyCorp, which is also coming out. Their provisions for credit losses increased more than expected at $139 million versus the estimate of $137.5. Total deposits coming in actually above expectations. So again, in line. I think that is the correct way of phrasing it. But what you're seeing right now goes to your real theme of survive, not thrive. This question of margin compression, this question of how much are they going to have to pay to keep their deposits, and how much are they going to have to pull back on their loans at a time when they really are compressed for where they're going to get their financing.
It's good news because there is no terrible news. There's no kind of like shocker, right, where you're holding on and wondering, can they get through this? Can they get through this?
You know, I don't know if I can even call it good news being borne out by markets, because you can see a real motley performance of the shares after some of these results come back. I mean, if you take a look, I keep going back to Zions. That was one of the problem children. Those shares lost a ton of value, almost 30% year to date. Those shares lower in pre-market trading significantly after missing on deposits. So I don't know. You know, I think that it remains to be seen just how much. It's not a terrible shock. I think people need to reassess the holistic aspect of some of these earnings.
Total average deposits. This is the period end. Average deposits flat compared to the fourth quarter at Fifth Third. Average total deposits flat compared to the fourth quarter. It's not terrible news for some of these guys. We'll keep going through it for you. That's the latest. Bear in mind that the post-SVB low was March 13th, and I think the equity market is up something like 8% since then on the S&P 500. We'll come back to these earnings in just a moment. I want to touch base in the bond market and have a look at how treasuries are evolving this morning. Yields have been backing up over the last couple of weeks. Yields are coming in now by 5 basis points on a 2-year. We break 420 at 419.32. Yields are down about 4 basis points on a 10-year at 355.27. Quick check of the FX market. Euro dollar 110.76 on Friday. New intraday high for the year. Right now 109.63 positive. 0.1%. We've gone through this slew of Fed speak coming up today. Let's do it again. Waller, Mester, Bowman, Logan, Bostic, Harker, all on deck. John Williams of the New York Fed speaking on the banking stress, saying this: the banking system is sound and resilient. Nonetheless, these developments will likely lead to some tightening in credit conditions for households and businesses, which in turn will weigh on spending. Eric Nelson, a macro strategist over at Wells Fargo, joins us right now. Eric, have we got the all clear to hike again in early May?
Yeah, John, I think the Fed is comfortable to hike again. And I think that really the question is more in terms of the guidance. We saw Powell was very concerned in terms of his rhetoric after the last meeting. Now that things have cooled down a little bit, or calmed down a little bit on the banking front, do you think the Fed can at least continue to hike? But I think there's still a lot of lingering concerns over credit tightening. Clearly, with some of the softness and the underlying labor momentum we've seen, I think the Fed's going to be a little bit more forward-looking in terms of their outlook on inflation. So I do think they're going to be cautious, not necessarily signaling an end to the tightening cycle, still kind of dangling those hikes in front of the market. But it does seem as though the Fed is pretty much done here from our perspective.
What does it mean in terms of the message that we've gotten from some of the regional banks? The fact that we have heard from a number of Fed speakers, from Fed members, concerned about credit tightening. Has that been confirmed from what we've seen so far from the regionals?
It's really tough to say, Lisa. I think you saw the Beige Book yesterday as well. It was already mentioned earlier in the show, and kind of some of the comments from some of the regions about declines or outright weakness in lending activity. But really, we saw this prior to the SVB crisis, right? Credit conditions were getting tighter. So it's not necessarily terribly surprising to see this kind of thing. I do think that, though, if the Fed looks at the confluence or really the whole holistic picture here, you add in the credit tightness, you add in the amount of tightening they've done, and, again, some of the weakness in whether it's construction jobs, manufacturing jobs, these very good cyclical indicators, it does seem as though the Fed is right to be getting close to a pause here.
It's one thing to pause, it's another thing to cut. And that's been one of the big debates, really, isn't necessarily whether the Fed pauses, but whether they start to heavily cut rates by the end of the year. We're still pricing in almost 0.6% or more of rate cuts by the end of this year. Do you think that that's an inaccurate read on a situation that, yes, spells weakness, but not the disinflationary push that the Fed wants?
Well, Lisa, I think it looked a little bit more offsides maybe two or 3 weeks ago when you saw, looking at the forward rates, rates down around 3% in the beginning of next year, or 3.5%. I think that it's hard to justify that with how early we are in this labor market and sort of broader cycle turning point. I do think that it's going to take some more significant deterioration to sort of vindicate that kind of cut pricing. Now that we've seen some of those cuts priced out, I think the market's closer to fair. Our economics team is still expecting a cut before the end of this year, which is a little bit below consensus. So I think that the market is again close to fair here with where they're pricing this.
Looking at some bank earnings elsewhere, we went through Fifth Third about 5 minutes ago. Let's talk about Comerica right now. EPS coming in at $2.39, the estimate $2.29. Provision for credit losses $30 million, the estimate $38.6 million. The net interest margin 3.57%, the estimate a bit higher than that, 375. Net interest income $708 million, the estimate 703.9. Lisa?
Well, I'm curious about this because this is actually following what we saw at Fifth Third and KeyCorp as well. How much is that net interest margin an expression of how much they're having to pay for deposits versus what they're earning on the loans? Is that really the sign that their profit margins are getting squeezed in a meaningful way?
The difference between surviving and not thriving for some of these financials. The banks have done terribly over the last year. The focus, Eric, as you know, has been all about the stress in the financial system over the last month or so, and that's where our focus has been. But I think over the last week, I think we've all found that shift back to traditional indicators. And from your perspective in the FX market, over the last 12 months, there seems to be this bias, Eric. You look at inflation data in DM, you gauge from that how far central banks need to go, and from that, basically, you say this currency is going to be stronger, that one's going to be weaker. Eric, is that still the case? Is high inflation still good for G10 currencies?
Well, it's becoming a little bit more tricky, John, and look no further than the reaction yesterday to the UK CPI print. Initially, sterling strengthened on the back of it, but it's since come off a little bit, and we're kind of flat over the past day. So if the Bank of England is not going to be responding to the stronger spot inflation, if it's going to say, well, we're looking at the forward-looking data, those aren't as encouraging, maybe some of the private wages data are rolling over, if they're going to look through some of this high spot inflation, it's hard to see how high and stronger than expected inflation continues to be good for G10 currencies. So that traditional relationship may become a little bit more unreliable going forward.
What's the big FX call now for you and the team, Eric?
Well, the yen looks attractive to me here, John, on sort of a 1 to 3 month forward basis. I mean, you look at where central banks are now versus wherever they were, say, a month or two ago. Yeah, we're talking about 6% terminal rate back in late Feb from the Fed. The ECB may have gotten above 4% on their terminal rate, but these central banks are much more cautious here, and we're looking at dollar yen around where it was prior to the SVB crisis. So I think if you're sort of concerned about the economic cycle turning here, central banks becoming a little bit more accommodative of inflation, closer to the end of their tightening cycles, the yen looks like it has probably the most to gain here in the G10 over the next few months.
We've been concerned about the economic cycle turning for the last 12 months, Eric. Still, Eric Nelson of Wells Fargo. It's a conversation that hasn't really changed. Your equity market this morning down about 0.7% on the S&P 500. Tesla having a little bit of a struggle after earnings yesterday after the close, and a focus this morning very much on the regional bank story. The smaller banks reporting through this morning, Lisa.
Yeah, and we're getting a number of motley reports, basically in line with expectations, although that profit margin we've talked about, the sort of net interest margin coming in lighter than expected at Fifth Third as well as Comerica. How much does that really speak to the story that we're going to see pressure the amount of loans that they're willing to extend? I also want to note that we're going to be getting a slew of industrials and utilities into next week. We did get AT&T, and it really questions what's safe. What's a conservative stock to invest in? This stock is down significantly in pre-market trading after saying that the free cash flow is $1 billion versus an estimate of $3.02 billion. How much on the margins do you start to get misses at a time when expectations have already been lowered to such a degree that these misses really have some significance for markets and their expectations?
Is tech still defensive?
Yeah.
I was just going through the calendar for earnings. Microsoft, April 25th. Google, April 25th, Amazon, April 27th, Apple in early May. That's where the focus will shift to over the next month or so. In the next hour at 7:30 Eastern Time, about 50 minutes from now, we'll catch up with RJ Gallo at Federated Hermes. Looking forward to that conversation. For the broader market, the attention is going to shift later towards the final Fed speak of the week, going into the quiet period before the decision in early May. I'll go through it again. Waller, Mester, Bowman, Logan, Bostic, Harker.
You just like saying that.
All speaking through today. It's just kind of ridiculous, isn't it?
Well, I don't really understand what we're going to learn from them. And I keep saying this, but I feel like recently the Fed speak has taken on less import just simply because they come out and they're saying, we don't know. We have no clue.
They genuinely
we're watching with you. And they genuinely don't. So we're all watching the same data and people are coming to different conclusions. My takeaway so far from the regional banks, and forgive me if I'm overstepping here, but to me, it's clear they're A, losing deposits, and B, being more cautious with their lending. That is the takeaway, which is exactly what people were expecting.
Yeah, I don't think you're overstepping at all. I think that's largely the consensus view at the moment. These banks are still struggling. It's stabilizing, and that gives you a little bit of confidence relative to the doom and gloom of a month ago. But for the Federal Reserve, they're still looking at the situation, the stress, the shock of the last month, and suggesting they are expecting some tightening of financial conditions and credit standards. Lisa, the issue, though, is that they have to calibrate policy, and we still don't know to what extent the shock of the last month will do some of the work for them. I don't think we've got the answer to that just yet.
And we're not going to get it from the 25 Fed speakers today.
Not at all. Not at all. We'll get it from the data.
Correct.
Over the next couple of months. 0.75% lower on the S&P 500. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy's plan to increase the debt ceiling by $1.5 trillion has been rejected by Democrats. It would have been enough to stave off a U.S. payments default until March of 2024. The proposal would raise the U.S. debt limit for about a year and cut discretionary spending by $130 billion. It also ends tax breaks for clean energy products and electric vehicles. European Union lawmakers have okayed the bloc's first rules to govern the cryptocurrency industry. The new rules will come into effect over the next 2 years. They've been welcomed by crypto executives who like the EU approach better than the U.S. tactic of policing the sector through enforcement actions. Critics say the rules are outdated before they even take place. SpaceX hopes to launch its next generation Starship rocket today. A problem with pressurization resulted in last week's planned launch being scrubbed. The test flight is seen as a key step towards SpaceX sending humans to the moon and Mars. The fight between HSBC and its biggest shareholder is heating up before next month's annual meeting. Ping An Insurance wants the bank to sign off on its lucrative Asia business. HSBC responded by saying the plan misunderstands the bank and would destroy shareholder value and mean lower dividends. And another sign that the slump in the computer chips isn't going away. Taiwan Semiconductor forecasts worse than anticipated revenue for the current quarter. Apple's most important chip maker warned that demand from the mobile and PC industries would remain soft for now. Global news powered by more than 2,700 journalists. I'm Lisa Mateo, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
I would imagine the regional banks are still going to be very weak. You've only seen the first hit, you've seen the first stresses come through over the last quarter or so. We're not in the camp of forecasting a recession, but we still believe that US growth will not be far off of zero for the next sequential quarters. And of course, that's going to hit the US regional banks.
Let's talk about those US banks. Sharon Bell of Goldman Sachs looking for weakness. We've got some weakness right now in the outlook from Comerica. Here's the latest on them. They see the second quarter net interest income down 11% to down 13% versus the first quarter. That headline again, this is their outlook. They see second quarter net interest income in a range of down 11% to down 13% versus the first quarter. They see 2023 net interest income up 6 to 7% versus 2022. So still looking for a positive year, positive growth at least, year to date. Lisa, as you know, that stock has had some trouble. We're down about 29%.
What is this factoring in terms of rate expectations? And that's, I think, one key question as you listen to some of the earnings calls on these regional banks that normally people pay no attention to. This time, no one paid attention to the big banks. But are they going to see the fact that average deposits came down about 4 to 6% versus the first quarter? Are they going to see that persist? And how much are they going to have to pay for those deposits? That's an unknown at this point.
We'll come back to the banks in just a moment. I want to talk about one big name and then get to the broader equity market, Tesla. looks like this in a pre-market, bit softer. It's had a great year to date, and I'm talking about the stock. It's done tremendously well year to date. It's down today by almost 7%. Margins took a hit off the price cuts. It looks like you might see more of the same from them. We can talk about the numbers a little bit later today. I'll catch up with Dan Ives of Wedbush, but here's the latest line from the bull himself, Dan Ives. With no rose-colored glasses, Lisa, margins are now a delicate issue that are keeping Tesla investors up at night. That's from one of the most bullish analysts out there on this name.
Tesla was a cash cow because their margins were incredible, and it's come clear that Elon Musk is not willing to demand that kind of premium in order to get that profit margin. Well, suddenly, what profit margin are they seeking? And if they continue to cut pricing, Tom raised a good point yesterday. How much do people who have bought cars at the original price feel cheated because they could have bought it at a lower price and that essentially it's lost value?
This is the deflation trap more broadly in economics, isn't it? You don't buy because you just wait a week,
exactly.
Wait a month.
Except that it's only Tesla, so, you know.
Yeah, well, the stock's down. It's a struggle. It's down by almost 7%. The broader equity market's down 0.7% on the S&P 500. Equity futures a little softer throughout the whole of this morning without showing much sign of recovering whatsoever. The broader story in the bond market, yields lower by 4 basis points, defensive at 3.55 on a US 10-year. Dollar not showing any strength. Euro showing a little bit. Euro firmer by a little more than 0.1% against the dollar. Euro dollar 109.72. Let's get back to the regional banking story. Tons of banks reporting through today. That means Herman Chan at Bloomberg Intelligence is going to be incredibly busy. Herman, talk to me today, and welcome to the program, sir. Talk to me today about what you're looking for with the team, what you're going to be focused on.
Yeah, we're going to be focused on commentary going forward on both deposits and the pace of deposit attrition. So you've seen some banks generally lose deposits in the first quarter, given the fact that there's been ongoing uncertainty and the fact that interest rates are higher. So there's a lot of alternatives for those deposits to exit the banking system. Second, we're looking for the pace of deposit costs and how much they're going up. As banks lose deposits, they are trying to reprice them to retain those relationships. So that just spells some contraction in the net interest margins and overall profitability. So those are the two things that we're keenly focused on into the first quarter earnings.
How would you characterize, Herman, what we've gotten so far, which hasn't been catastrophic, but hasn't really been great either?
Right. Banks are just muddling through. The contagion risk that happened following the SVB and Signature failures really hasn't affected the overall regional bank industry. So liquidity, funding, all of those catch-all phrases, those all look fairly stable from a balance sheet standpoint. But it's just an earnings issue going forward. How much are our revenues going to contract? How much are net interest margins going to fall, given the fact that deposits and funding costs are rising?
Herman, if you were going to be having a conversation with John Williams of the Fed or with Austin Goolsbee of Chicago's Fed, what would you tell them in terms of how quickly credit is contracting from one of the main extenders of credit to Main Street in the United States?
Right. That's the issue, because if deposits are going to the money center banks, the money center banks aren't funding the loans in the local communities of certain areas that the regional banks really deal with on a day-to-day basis. So that would be the primary issue. We've seen some banks talk about the fact that demand has softened a little bit with CapEx spending declining. And we've seen banks also talk about the supply of lending has fallen a bit because they're worried about what the future holds and potential recession around the corner.
Herman, there seems to be a conclusion that there's no turning back now. I just want to build on something that Lisa's talked about over the last 10 minutes, and she's rightly pointing out that the profitability of the regional banks, the smaller banks, is going to be hit, perhaps permanently. Do you see it that way? Have we gone through something whereby there's no turning back here, that we're on a one-way road towards lower margins?
You could expect margins to come down. We're in the cycle where the benefits of interest rate rising has already happened, and it benefited the banks last year. So this year, you're going to see a bit of a give back in those margin gains from last year, given the fact that deposit rates are rising and funding costs are rising, and there's been a mix shift in the funding structure of these banks. But from a profitability standpoint, there are some headwinds, because you're going to see higher expenses from the banks having to to replenish the deposit insurance fund. So that's going to be a marginal cost for them. And there's going to be more regulation. So that will hurt profitability and returns. So because they're going to have to manage their balance sheet maybe a bit differently than they were before, with higher capital levels, higher debt levels. So all of that means that profitability probably comes down.
To what degree does that same argument apply to the major banks, Herman, from your perspective?
Yeah, the major banks already have to deal with these capital issues. So they are the gold standard in terms of capital ratios and capital requirements. So they're already there. And the regional banks will have to catch up a little bit. Maybe not to the same extent, but it will be a more onerous regulatory regime for the regionals going forward.
Herman, you've got such a calm tone and such a methodical way of going through it, which is really nice. And it sort of goes against some of the catastrophic tones that we're hearing out of some people saying regional banks are never going to survive in the same kind of way. This is a new S&L crisis. How do you push back, or do you not? Do you basically say, yeah, they're right, it just is going to be slower moving and it is what it is?
I would say that the issues surrounding the regional bank space was really idiosyncratic, related to a couple of bad actors with SVB and Signature that managed their balance sheet in a different way and didn't appreciate the risk they were putting onto their balance sheet. Overall, the other regional banks that we cover, they don't manage the balance sheet like that. They're more conservative, and so that should help them bridge the gap between the current uncertainty and a more normalized pattern of operation. So that's what we expect. That's what our view was going into the crisis with SVB failing. And first quarter results really confirmed that the industry is safe and in firm footing. So it's just more of an earnings issue than a solvency issue.
It has been brutal.
For the regionals.
Brutal year to date, looking at some of these names on the screen. Herman, thanks for being with us, sir. Herman Chan there of Bloomberg Intelligence on some of the regional banks. You'll hear more from those banks a little bit later. That word, the buzzword of the last couple of weeks, idiosyncratic. More idiosyncratic than systemic seems to be the argument coming from Andrew Hollenhorst, Veronica Clark over at Citigroup as well. They're looking for this from the Federal Reserve. 25 basis points in May, go again in June, go again in July. That's the call from Citi. They've stuck with that, Lisa. They haven't backed away from it.
Which I respect, especially given the fluctuations that we've seen and, frankly, round trip that's come a little bit closer back to them. There are two issues here, though, and I think it's really important to delineate between the catastrophic banking crisis with a domino effect of one failed bank and something that is a slower grind of just tighter credit. And we saw that yesterday from Ally Financial. Nobody really talked about this, but their auto loan originations came down significantly, were below expectations. You are going to see this on the margins because at a certain point, those net charge-off rates from people who have soured credit suddenly start to really hurt the bottom line if you're really working on thinner margins.
You know what we haven't seen? Any of the bears capitulate on anything ever since this equity market rallied off the bottom from the middle of March. Up about 8%. Just haven't seen the equity market bears back away. Wilson, Kolanovic, can name a few others, just haven't changed their view, much like Citi and Hollenhorst.
Have the earnings confirmed what they're looking for, but the price action not? That's the issue.
We'll get the latest from Julian Emmanuel over at Evercore. He'll be joining us very shortly. The broader equity market this morning down about 0.7%. Alongside Lisa Abramowitz, I'm Jonathan Ferro. TK is going to make it back tomorrow, we hope. He's taken a well-earned rest. Yields a little bit lower, down 4 basis points. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
People are starting to have a little bit of a fear of missing out.
This is really a story of who can maintain profit margins in a declining nominal inflation environment.
The entire banking system is going to see their deposits shrink.
Everybody's anticipating that we're still going to have this tightening of lending conditions, tightening of credit conditions that takes place.
What got us into this issue to begin with was higher rates. The longer you keep them there, it's going to expose other fragilities.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a busy morning for you. And live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK is going to drop by, we hope, tomorrow. Looking forward to that. Equity markets right now on the S&P 500, negative 0.6%. Lots of bank earnings this morning. Lots of Fed speak a little bit later. We'll go through the times, the dates, and everything you need to know going into the quiet period in just a moment. But so far, Lisa, the financials, there is a theme that you've identified. Deposits, things might be stabilizing. I get it. We've seen that consistently over the last several days. But when it comes to profitability, there seems to be a bit of disappointment emerging.
It's coming in lower than expected. The net interest margin, miss, one after another. The latest coming from Truist, coming out is saying that their net interest margin was 3.17%, the estimate 3.26%. Not catastrophic, but on the margins, you're seeing them have to pay up for deposits, and it's not being offset by how much more they can charge on some of their interest-bearing loans.
We've heard from Fifth Third. We've heard from Comerica. Is there a broader macroeconomic signal here about where this is going in the future? We understand, to some extent, with some degree of clarity, the shock of the last month. Do we understand the process that a lot of people think has started?
No, we don't understand the depth of it. We don't understand how much that will accelerate some sort of recession or downturn. We don't understand how much that's going to bring inflation lower. Fed officials don't understand this. Economists don't understand it. But what they are saying is it will have a material impact, and we just don't know how much it's going to accelerate because there are so many unknowns in the meantime about the state of these banks and, frankly, what's going on in a macroeconomic standpoint.
So later today, when we hear from Wallen, Mester, Bowman, Logan, Bostic, Harker,
beautiful,
is everything going to be solved?
I think that you should do a children's story about that. You know, they all go to the store together. Look, I don't think that they're going to be able to tell us anything because, frankly, they don't know anything more than we do. I do think that the takeaway so far, though, from some of these smaller banks is that, yes, there's been a lot of bad news priced in. but perhaps it was rightly so, and perhaps we still face more pain ahead. People are going to be talking about consolidation, and people are going to be talking about the people who are going to be left unbanked or uncredited, who are not going to be able to access credit in the same kind of way at a time when there is a much higher premium on getting your money back.
Pre-market, KeyCorp down a little more than 2%, Comerica down 2.74%, Fifth Third down not even 1 full percentage point. The broader market, equity struggling, we're down 0.7% on the S&P 500, futures negative. Tesla having a difficult morning. We'll mention that repeatedly through this morning and keep you on top of the price action. We're down about 6 or 7% on Tesla. Yields come in about 4 basis points defensive across the board here. Lisa, the 10-year, 355.
All right, today we are expecting this roll of earnings to continue throughout the day. Huntington Bank shares expected to come out any minute. We're also getting a host of others, Synovus Financial, East West Bancorp. How much are we going to see this theme persist after already so much pain has been priced in? I mean, if you take a look at the performance year to date, dramatic underperformance. KeyCorp down almost 30% on the year. Fifth Third down already almost 15%. Truist down almost 20%. And now building on those losses as there is a clear concern about the profitability in the face of higher deposit rates. 10:15 a.m., Treasury Secretary Janet Yellen is giving a speech on U.S.-China economic relations. John, you pointed earlier this morning to quotes from her ahead of that speech talking about how national security is number one, and that supersedes economic interests. A change in tone, or perhaps just an underscoring of what everybody's been talking about behind the scenes.
I think it's exactly the latter. It's an underscoring of what we already know, and pretty emphatic. And I think we said to Anne-Marie yesterday when we were discussing this speech, which happens a little bit later on this morning, at least as you say, at 10:15 Eastern Time, would the Economist start to sound like a politician? I would say, based on that quote, the Economist is starting to sound like a politician. When you start to say things like that, national security trumps economic interest, that's a big change for the former Fed chair.
Yes, although on the flip side, the IMF, who are supposed to be the economists, were not addressing the political overhang. And you cannot ignore geopolitics when you're sort of trying to game out the economic implications. And that's a very difficult kind of, wire to walk. And this, I think, is what we're going to hear from Janet Yellen, who's going to be accused very much of politics.
Can we ignore this, the Fed speak?
Well, I really wanted you to do that again because I really enjoy it when you do it. Come on, go ahead.
You want me to go again?
Waller, Mester,
Bowman, Logan, Bostic, Harkin. A little bit later. It's exciting,
better.
isn't it?
It's really good. Anyway, all of them, they're going to be speaking.
Julian Emmanuel's alongside us, just shaking his head about all of this. He joins us from Evercore. Julian, what do you make of that, just before the quiet period, that many Fed speakers?
What I make of it is that your ability to do tongue twisters is absolutely phenomenal, John.
I was an MC, DJ back in the day.
Of course, he was.
I wasn't at all. Go on, Julian.
So all I can say is when looking at this morning and the setup, given the earnings volatility we've seen so far today, is cautious at the outset. Let us recall the last time Secretary Yellen spoke alongside the Fed, which was Jay Powell. We had an enormous amount of volatility. And the fact that we're in all likelihood going to get two conflicting messages, a bunch of Fed speak coming out probably hinting towards one and done, which is our view, as opposed to, okay, well, the economy is now taking second spot to political relations coming from the Treasury Secretary. There's a lot of confusion here.
One and done, then pause. Some people see that pause as bullish, others don't. I might include you in that. Over the weekend, I was reading your research to start a new week. This quote jumped out to me. 23's pause is likely to see a further sell-off, recession volatility spike before the inevitable new bull market gain. Can you put some numbers on that? How are you thinking about that situation?
Sure. So if you look at it, the history of pauses tends to be on a 12-month basis quite positive. We expect that. But the problem here is you've still got to get through the recession. And yes, we've all been waiting for the recession for a year now. Remember, there were 2 back-to-back negative GDP quarters to start 2022. So the watch is on. But ultimately, part of this calculus is that we've had so much more tightening since that time. It doesn't take away the concept of recession. The watch pot is going to boil. And so for us, when we look at the last month, what's clear is that the reason the market traded positively into the trough of the banking turmoil back in March is because it began discounting the pause prematurely. It's in the price now. So it isn't necessarily a bullish outcome. And look, it's been our expectation, as you know, and this is a frustrating market for both bulls and bears, but it's been our expectation for 6 months now that at some point, given a recession ahead of us, one or more of the major indices is going to test those October lows.
So if you were John Williams, you'd probably be glued to your terminal this morning looking at these small bank earnings and parsing through their balance sheets to understand the state of credit creation in the United States. It seems like what they're doing right now. What would your conclusion be in terms of, is this just an idiosyncratic issue that leaves us in the same place, or was this clearly something more?
Well, you know, the whole concept of idiosyncratic across every company that's reporting is a little bit of a misnomer in general. This is a process. Part of the fact that we created so much liquidity through fiscal and monetary expansion over a couple of years to fight the pandemic means that the other side of this unwind is a process as opposed to a shock. This is all part of the process. And frankly, when you look at the longer term, it's better that it's going to take a while than, you know, more sort of near-death experiences like last month. But it doesn't mean that the stress is going to go away. It's just going to roll out over a longer period of time.
What does this process mean? Does that mean that regional banks are uninvestable for you, or does this mean that you're going to just sort of see a roll-up and a survival of the fittest?
So the question here is, you know, where are the next dominoes likely to fall? And I don't know that we know any more about that now than we did 2 or 3 weeks ago, or even 2 or 3 hours ago, before these reports came out. So I think we'll just have to look. And part of the issue that we have is that you had such a sell-off over that month in the regional banks. And look, the fact of the matter is when you sort of anticipate the news, and I don't think anyone's surprised by the earnings reports we've seen this morning, but the shares don't respond even after this massive sell-off. That's not a great message.
Is Tesla idiosyncratic?
No.
Why not?
Because basically what you're seeing, and this is the dichotomy and why the market's actually been trading sideways. Look, Ed Hyman has been extremely optimistic about the trajectory of inflation over this year and into next. We're going to get a two-handle on inflation. Is that in all clear? Well, it's probably not, because the way that you get to the two-handle is through an economic downturn. And that's what that earnings report is telling us.
When do we get that two-handle? This year? Next year?
At the end of this year, we think so.
You think at the end of this year,
we do.
Two-handle on CPI?
We do.
Is that headline core? What is that?
So again, you can parse and you can parse. We'll go with core. We'll go with core PCE just to make the Fed happy.
Okay.
Can I just ask you, given the fact that we really haven't gotten great earnings, there have been plenty of disappointments. Why has the market not come around to your view and to the bearish views of the likes of Mike Wilson?
Well, because again, if you look at the last year, we were so obsessed with inflation that the fact that it's coming down in an environment where, yes, we've done a huge amount of tightening, but the liquidity provision over those first couple of years to fight the pandemic is so extreme. If you look at M2 is contracting right now, but the growth trend line, regression line, is still well below where we are. So there's residual liquidity in the system, and positioning has been bearish for the most part. So we're at this stalemate.
Just to be clear here, you're still at 4150 year end on the S&P 500.
Let's end the year right now.
We're at 4150 right now. You just see a lot of volatility between now and then, right?
If anyone thinks about convexity in their portfolio, it is time to load up on convexity. Whether you're bullish or bearish, the VIX at 17 is way too low.
End the year right now, Bramo. You ready to go?
Yeah, absolutely. Let's go.
Where are we going?
Let's go on vacation. I know where you want to go.
Where am I going?
You're going to go to an AC Milan game.
I'd love to.
I know, that's where you want to go.
I'm trying to secure tickets
I know.
right now.
I know.
Still need to talk to management to get the time off, but I'm trying to find the tickets first. You know, get the tickets first.
Obviously.
Then have the debate internally in the newsroom. Can I cover it? Can we take a camera? Can you pay for the flights? Something like that. Julian, thank you. Appreciate it, buddy, as always. Julian Manuel.
This is what he would do.
Cool. Oh, TK, definitely.
100%.
Oh, yeah, that's
Why
where
do
he
you
is
think
right
he likes
now.
the road trips?
He's trying to plan a road trip. Coming up in the next hour, Liz Young of SoFi. Looking forward to that conversation. Futures down about 0.6%. We're trying to bounce from session lows.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says that U.S. security worries on China are more important than economic interests. Yellen speaks in Washington today. She says the Biden administration will not compromise with Beijing on security concerns. Democrats are rejecting House Speaker Kevin McCarthy's proposal to raise the debt limit for about a year and cut government spending. The plan would increase the debt ceiling by $1.5 trillion. It would also cut discretionary spending by $130 billion. If the debt limit isn't raised, the U.S. would default on payment obligations as soon as June. The U.S. Supreme Court has extended access to a widely used abortion pill until at least Friday. Justices are considering whether to allow restrictions on the drug to take effect. A lower court in Texas has ruled in favor of the abortion opponents who want to roll back FDA approval of the pill. Bloomberg's learned that a secret recording by a fired Fox News producer helped push the network to its settlement of a defamation lawsuit by Dominion Voting Systems. Fox lawyers feared that the recordings made by Abby Grossberg and her testimony would be used against Fox chairman Rupert Murdoch and other witnesses. A Fox spokeswoman calls the account of the recordings widely inaccurate. And Tesla will continue to cut prices to spark demand for its electric vehicles. Elon Musk argued that he has good reasons for doing so. He said that Tesla can withstand price cuts, giving it the upper hand against rivals. Investors aren't so sure. Shares lower in pre-market trading. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
MAGA Republican Congress are threatening to default on the national debt. They say they're going to default unless I agree to all these wacko notions they have. America is not a deadbeat nation. We meet our obligations.
Today, I'm proud to announce that we are introducing the Limit, Save, Grow Act of 2023. President Biden has a choice. Come to the table and stop playing partisan political games. Or cover his ears, refuse to negotiate, and risk bumbling his way into the first default in our nation's history.
As you can tell, as expected, talks between President Biden and Speaker McCarthy are going really well over the debt ceiling.
Same thing.
It's just kind of back and forth to nowhere.
Whack-a-mole, or just kind of whatever. Cover your ears and la 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 la. Like
how long are we doing this for?
I mean, literally,
2
it's
months,
just children.
3, 4.
I mean,
hit the X date.
Yeah, we don't know, and it's sort of this back and forth and this political theater that continues, even though there's a pretty big consequence at stake.
a major consequence at stake
Yes.
that still Wall Street is just refusing to discuss based on the conversations I've had, Lisa. And in fairness, what can they discuss
Well, that's the whole
right
thing.
now?
I mean, what can they say other than, yeah, this would be really problematic, but they probably won't get there, but we don't really know. And it's exhausting. I mean, given all of the other turmoil and churn and things we don't know, to then introduce this unknown that's just an irritant is difficult.
The Fed speak is an irritant as well, and you'll get tons of it a little bit later. It's an irritant for some of you. Some of you enjoy it, I know. The equity market right now down about 0.6% on the S&P 500. A busy morning for you all. In the bond market, yields are a little bit lower by 4 basis points, 420 on a 2-year. In the FX market, euro dollar firmer by a little more than 0.1%, 109.72. Tesla, the stock to watch this morning, a bit softer. Lighter, lower, negative, down by almost 7% off the back of that margin hit, off the back of price cuts, which you can expect more of, apparently, from Tesla. They're going for volume. They're going to sacrifice profitability, and that's the direction of travel. Later today, Lisa, the conversation for Elon Musk will shift from Tesla to SpaceX. I understand that launch is going to happen a little bit later this morning, in about 2 hours or so from now.
I'd love to have a long conversation about traveling to Mars and getting back and on all of that. I do want to just emphasize, though, what Julian Manuel was talking about, that it is not an idiosyncratic story. When we talk about Tesla, this is the seeds of disinflation. This is the seeds of trying to generate volume and potentially sacrificing margins as a result. And this is really going to be a theme that he said that we're going to see increasingly that will precipitate a downturn.
Julian should have stayed.
I know.
I could talk to Julian all day. I could talk to Mohammed Al-Erin all day as well. He's going to join us in a couple of hours, 9 o'clock Eastern time. So about 1 hour, 40 minutes from now in the studio in New York. So looking forward to doing that with him. He co-hosts and asks better questions than us. And it just drives me nuts, but I still let him back. Anne-Marie joins us now, Bloomberg Washington correspondent. AMH, great to catch up with you and good morning. I want to go straight to that quote from the Treasury Secretary that I know you've already read about 10 different times. National security is of paramount importance in our relationship with China. The Treasury Secretary went on to say, we will not compromise on these concerns, even when they force trade-offs with our economic interests. Now, Anne-Marie, that's just one paragraph, one quote from a speech we'll get at 10:15 Eastern time this morning. AMH, what else are you expecting?
Well, that quote for me, like you, Jonathan, mentioning a number of times this morning, is actually really key because I think that's what's been going on behind the scenes. But now you have the Treasury Secretary in this very extensive speech on China, the first we've really seen from her, mapping out how the U.S. continues to see the economic policies between Beijing and Washington progressing. And the reason why I say that this is now in black and white, because remember when the Biden administration was really struggling to deal with inflation? It was at that point when some of the economic voices in the Biden administration was talking about, well, maybe it's time we lift some of these tariffs, the Trump era tariffs, that still to this day, the Biden administration has maintained. And they're using that, particularly, many would argue, as leverage when it comes to national security interests. And really what she's saying is that at the bottom line, push comes to shove, we are going to be leaning into the national security protections of the United States versus the economy. And we've seen this time and time again with this administration, whether or not it's not lifting the Trump era tariffs, it's the export controls. It's making sure China doesn't have access to advanced technology and going even above and beyond and getting other countries to line up with them like Netherlands and Japan. So I think she's going to outline that particularly today. And then also she will have to point to some areas of engagement, most notably climate change and debt distress.
Anne-Marie, is there any significance as to why now? I mean, she's been in her position for quite a while. We've been talking about these issues for quite a while. Is there a significance to at a point where we're talking about potential economic weakness, but also ratcheting up of concerns with spy balloons and Taiwan?
Yeah. Well, so remember, Biden and Xi sat together in Bali. I was there at the G20, and this whole meeting was about putting a floor under the relationship, and their teams were tasked to then go work together. And then what happened? The spy balloon, that really derailed that plan because Secretary of State Antony Blinken was set to go, and now that trip was postponed, and we still don't have a date. Secretary Yellen is also scheduled to go to Beijing in the spring, and yet we don't have a firm date. So potentially this is the opening mentioning of her trip that at some point we would see her going on. And she also will talk about in this speech the fact that she is going to be, or the Biden administration will be upfront with China on issues that they have, whether it's national security, but also economic issues. And she's really laying them out in black and white. So for me, this would be her laying them out in this speech and then preparing to go on a trip. Also making sure that she's saying, by going to Beijing, we're not looking weak to China.
Or some of these national security issues.
I think what we've seen based off build up. So when you look at the advanced technologies, it's the advanced technologies that China's military wants to get their hands on. And one of the concerns with the Biden administration, obviously, and you've heard from the Pentagon, is about China's assertiveness when it comes to Taiwan. And there was a recent flashpoint as well in the Taiwan Strait following Tsai Ing-wen's visit. I was also there when she met with Speaker McCarthy in this unprecedented visit, the first time we had a Taiwanese president meeting a high-level official on U.S. soil, and then obviously there was repercussions in the Taiwan Strait. So this is the concern the administration has. So I think when you look at some of these export controls, you can really trace some of them back to how this could help advance the Chinese military.
This is the relationship between the United States, China, the rest of the world. Let's talk about the relationship between the President of the United States and a Speaker of the House, Kevin McCarthy. That line from the President of the United States, let's get to that line. They say they're going to default unless I agree to all these wacko notions they have. Speaker McCarthy saying the president ultimately has a choice, come to the table or refuse to negotiate and risk bumbling his way into the first default in our nation's history. Can I just pick on Speaker McCarthy's thoughts right now, Anne-Marie? You caught up with him in the last couple of weeks. Who does he need to negotiate with? The president or his own party?
Two, first, his own party. He has to get 218 votes. And I think Libby Cantrell in the last hour speaking with you guys really outlined how difficult that is for him, because he can only lose 4 Republican votes because not a single Democrat is going to vote for this. And you saw how difficult it was to even get the votes to become speaker. How difficult is it going to be for him to coalesce his party around this one idea? But now he has a more than 300-page bill. It has hit the floor. He gave a speech, and they are working on making sure they can whip the votes for next week. So that's his first point of business, getting his ducks in a row, literally the spectrum of views of the Republican Party in the House. Once he has that, he's going to then go to the president for leverage. The president keeps saying, you have to show me a budget in order to negotiate. I outlined my priorities for the American people. The Republican Party needs to outline them. He's not going to have a budget, but he will have this bill. And potentially what the McCarthy team wants is to show the White House this bill and say, now you have to negotiate with us because we have the votes in the House. The bill's not going anywhere, but it is a leveraging tool.
AMH, appreciate your time. As always, down in Washington. Anne-Marie, watch out for Anne-Marie and Joe Matthew a little bit later. They will cover Balance of Power. That program will take place at about 5 p.m. Eastern time, a little bit later on this afternoon. Lisa, have we narrowed the window for the X-date? Has it come in a little bit? We got a decent idea of where this falls?
Kind of, but it could kind of get fudged as we get a clearer sense of what kind of receipts we got from the taxes. When do we start caring? Is it 2 weeks beforehand? Is it 3 days? I mean, when's sort of the, immediacy?
I'm with you.
Come step in.
The market moment.
Yes, thank you.
Yeah, the market moment. Close, I would say. Close to the, because no one wants to talk about it. RJ Gallo of Federated Hermes coming up.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome to the program this Thursday morning. Good morning to you all. Your equity market just a bit softer, struggling here just a little bit. We're down 0.6% on the S&P 500. The Nasdaq down by 0.9%. We can talk about the banks and Tesla in just a moment. Allow me to whip through the bond market for you. Yields are coming in about 4 basis points on a 2-year, 4.20 there. Your 10-year yield down 3 basis points to 3.56. The curve just a tiny bit steeper here, just a tiny bit steeper, led by that move at the front end of the curve. In the FX market, euro dollar is positive 0.1%, 109.72. Not doing that too much there either. We're positive by a little more than 0.1%. We've gone through the Fed speak a million times. You'll hear from 6 Fed officials today alone.
Come on, go.
I'm not going to do it again.
Aw.
Going into the quiet period this weekend before the Federal Reserve meets and decides on May 3rd. So that May 3rd decision, most people assuming 25 basis point hike. They're not offering much guidance beyond that at the moment because ultimately it's one more hike that is implied by the median dot in their projections. And I wonder what that news conference is going to sound like in early May.
What matters more to you? Whether they hike rates after that or whether they hold rates throughout the year at those levels?
That's what they're implying. So that's the guidance. What matters to me is whether the guidance changes. Have I fudged that? I hope I haven't, because ultimately that's what matters to me, is how the guidance changes.
Well, honestly, this is basically the Fed is following right now what we're following in the markets, which is regional banks. And the regional banks are clearly not doing great. I mean, there already has been a tremendous decline in the share prices. And now after earnings, they're going even lower. And that to me, as frankly, as Julian Emmanuel was saying, tells you so much. The fact that there's been a lot of pain priced in and now even more after you see what's going on under the hood tells you something. Fifth Third shares down 1.4%. Taking a look at Zions Bank after reporting earnings yesterday, down more than 5% in pre-market trading. First Republic, which reports on Monday, I believe, down 2.5%. And Truist, which reported this morning, down almost 1%. The story for me is net interest income. You are seeing it really struggle given the net interest margins, I should say, not revenue, but net interest margins, considering how much they're going to have to pay for deposits at a time when suddenly that matters. I don't know. John, to me, I feel like this story has changed.
No, I agree. The profitability story is the one to focus on. For the broader market, though, for the macro economy, you just want to know that things have stabilized, right? That's kind of the thing you're looking at because of the stress of the last month. You want the stability first, and then you wait through and work through the next phase of this. The first phase is shock, crisis, survive. The next phase is a better understanding of where profits are going and what it means for lending standards in the coming months, quarters, and maybe even years.
And as we parse through that, we get a whole host of other earnings. And you've been mentioning Tesla, and rightly so, throughout the morning. And we should take a look at those shares, which are lower by more than 7%. The loss is deepening throughout the morning ahead of the open after reporting that they expect to keep cutting prices in order to generate higher volumes. The profit margin likely to deteriorate further, raising real questions about demand, as well as the disinflationary forces, not just for Tesla, but broader as well.
That stock is down 7%. The ECB does not do minutes. They call them accounts. I remember when they first started doing this. They're not minutes, they're accounts.
What's the difference?
Of the meeting. Less detail. They don't get down to the couple, the several, the few, the one. They say things like this. A very large majority agreed to raise rates by 50 basis points at the last meeting.
Very European.
Do you remember we asked a couple of months ago, all our guests, when I was over in London, who's going to hike more this year, the ECB or the Fed? And everyone said the ECB. And it seems like it's going that way, doesn't it?
Absolutely, but they had further to go as well. And it's clear that the inflation problem there is also perhaps a bit stickier or later in terms of getting up to speed than in the U.S.
May 3rd, the Federal Reserve decides. The day after, May 4th, you'll hear from the European Central Bank and the President, Christine Lagarde. Joining us now is RJ Gallo, Senior Portfolio Manager at Federated Hermes. RJ, wonderful to catch up with you, sir. I know you've tuned in and you've been listening to the program this morning, and you've heard that word that drives us all nuts. It's the word that people use when they see something they don't like, that it doesn't fit into the broader argument that they've got. They say it's idiosyncratic, RJ, and sometimes it is, sometimes it isn't. Is this idiosyncratic, RJ?
Yeah, the word's been repeated quite a bit this morning. I often turn you guys on quite early, and I'm of the view that when there's enough problems that have emerged that get called idiosyncratic by various market participants, you start to look for a theme. I think with respect to the banks, a lot of bank earnings coming out, there are themes here. It's undeniable that large losses on fixed income securities and high uninsured deposits created a poisonous and dangerous mixture at SVB. And they were extremely exposed. That put them under. But thematically, we're seeing the effect in the bank earnings. We're seeing some deposit loss. We're seeing the need to raise deposit costs. The theme is clearly still out there. And I believe that that is going to be a headwind to the economy. Yes, the crisis never fully emerged because of quick action on the part of mostly official Washington and the prudent moves by banks that didn't take the same reckless measures as the others. But we're still dealing with the echoes of the crisis, which are going to slow the economy, hit the banking sector, and make a recession even more likely as the year ticks forward.
What does this theme that is emerging mean in terms of how you're positioning your portfolio, how you're positioning yourself for the rest of the year?
It's been a heck of a year. I mean, volatility is, in all caps, describes 2022 and 2023 in bonds, and 2022 is deep losses. In 2023, the tail of the tape right now, most bond indices, broad-based bond indices, the Universal, the Ag, the Muni Index, they're all up about 2.5%. It's a lot better than double-digit losses of last year. So that's part of the theme, that the cost of last year, in terms of big losses, opens up the door for bond returns to improve. We started the year with a neutral and at times long duration. Currently, we're about neutral. We were surprised, as many were, by the banking stress and the issues of distress on the part of the few. But we think that the thesis of being long and looking for bonds to be a positive contributor to your overall investment portfolio is only bolstered by what has happened in the banking sector, and as we move forward, the ramifications of it. Less credit creation, slower economic growth, renewed disinflation, those are all bond-friendly factors. We're positioning neutral and looking for an opportunity to get long again. And we're up in credit quality. We're underweight high yield. We're underweight investment grade corporates as well, and underweight CMBS, overweight mortgages, and holding plenty of treasuries because we think a recession is more likely than not.
We heard from a number of investors that they are waiting to invest in regional banks, that they're seeing this as a buying opportunity, and then the results came in, and it hasn't been. How much do you see this as a potential opportunity versus just an ongoing signal of distress that edifies your feeling of up in quality?
Well, I think focusing on the banks just for the moment, the equity investors' view and the fixed income investors' view might diverge a little bit. The fact that the FHLB lent hundreds of billions of dollars, that the Fed, the FDIC, the Treasury acted quickly to avoid stress from becoming crisis, helped everybody. But you'll notice that the equities haven't bounced back because the profitability ramifications of what has gone on were only highlighted and in many ways amplified by what was going on. So it doesn't surprise me that the stocks haven't bounced back too much. From a fixed income investor standpoint, I think it reinforces our broader themes. We still like, in general, the banks that we tend to be within our corporate portfolios more favorable towards the large, the G-SIBs, if you will. But we do believe that the worst of this stress is behind us. It's now become a condition. It's sort of like when a cold snap hits New York. It affects everybody. Everybody retreats to their apartments and their homes, turns up the heat, buys extra groceries. But the most vulnerable out there, often the homeless, they struggle when it's -5 degrees in New York City more than anyone else. So the theme, the bad weather, is still affecting all of us, and we think it's going to lead us down a recessionary path in time.
RJ, you talked about the up in quality. Can we talk about that a little bit more in the credit market? So for those outside of Wall Street, in the credit market, the dividing line between investment grade and high yield junk, so to speak, triple B to double B, there's that line. Right. Now, RJ, when people say up in quality, ultimately sometimes they mean investment grade over high yield, over junk. A lot of these banks were IG. RJ, sure. They got into trouble over the last month, and I just wonder how you're looking at that in investment grade and what the process is for you and the team and what we've learned over the last couple of months.
Sure, it's a very good question. Number one, when I mention up in quality, we're overweight mortgage-backed securities where your risks are volatility, prepayments, not credit.
Right.
So that's very up in quality. We actually remain underweight investment grade, although we did in fact reduce our underweight as spreads widened on the banking stress as an opportunity sort of to tactically get a little closer to neutral, but we still carry an underweight position. In a pecking order sense, we are more underweight the most credit-intensive below investment-grade securities, the place where a recession typically will produce much wider spreads and therefore underperformance on total return, and will actually increase the risk of defaults, where the number of distress cases will go up in below investment-grade securities. In the investment-grade world, we also think spreads will widen, but the consequences will be somewhat less. We're not expecting a bunch of downgrades into below investment grade. That's why in our pecking order, we're more underweight high yield than IG. And as I mentioned, we're actually overweight mortgage-backed securities and owning plenty of treasuries. So the dividing line, it's somewhat more of a spectrum, if you will, in terms of how we're looking at our multi-sector portfolio.
Thanks for that clarity, RJ. Just one additional question on high yield. The pushback I think we're both confronted with, Lisa hears this as well, from the people who are constructive on high yield. They say things like, we just haven't had the credit cycle in quite the same way this time around. We haven't built up that leverage through the pandemic. We had these monster fiscal transfers. Companies got religion. They didn't go out and do silly things over the last 3 years. We've all heard the same arguments, RJ. When you're confronted with that argument, what do you say back to people?
We still think the economic cycle will have the same character as other economic cycles, that cash flows relative to debt, the ability to service that debt, the risk around a bad outcome, namely a default, those have not been removed or insulated by some of the positive things that have gone on in terms of corporate management and recent behavior. I think in the end, again, in a sort of spectrum or pecking order sense, underperformance will still emerge. It may not be the same level of defaults where you actually have companies, filing bankruptcy cases, but it will be a case for relative performance where high yield will underperform other elements of fixed income in your portfolio, and that is the expectation that we have that has prompted us to keep that underweight position. It doesn't mean that this has to be as severe of a credit crunch or a default wave as we've seen in other more drastic periods in the longer-term history of the market.
RJ, thank you. Again, on the market, RJ Gallo of Federated Hermes. If you hear the word idiosyncratic enough, then maybe it's not idiosyncratic. Perhaps you have a theme, Bramo. Seems to be the takeaway.
We've heard that now from both RJ Gallo as well as Julian Emanuel. Basically, how many times can you say idiosyncratic before you've created a trend yourself?
On the regional banks, coming up next, Christopher Marinac of Janney Montgomery Scott. Looking forward to that conversation. Equity futures right now down 6 or 0.7%. Yields a little bit lower by a couple of basis points. 356.61.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Outside Paris today, protesters angry over French pension reforms stormed the entrance hall of stock exchange operator Euronext. Railway workers and others chanted, set off flares, and waved union flags. Euronext says operations were not affected. Anger over President Macron's decision to raise the retirement age from 62 to 64 remains strong. House Speaker Kevin McCarthy's plan to increase the debt ceiling by $1.5 trillion has been rejected by Democrats. It would have been enough to stave off a U.S. payments default until March of 2024. The proposal would raise the U.S. debt limit for about a year and cut discretionary spending by $130 billion. It also ends tax breaks for clean energy projects and electric vehicles. European Union lawmakers have okayed the bloc's first rules to govern the cryptocurrency industry. The new rules will come into effect over the next 2 years. They're being welcomed by crypto executives who like the EU approach better than the U.S. tactic of policying the sector through enforcement actions. Now, critics say the rules are outdated before they even take effect. SpaceX hopes to launch its next-generation Starship rocket today. A problem with pressurization resulted in last week's planned launch being scrubbed. The test flight is seen as a key step towards SpaceX sending humans to the moon and Mars. And a mixed bag of results for AT&T. The phone giant reported free cash flow that missed estimates in the first quarter, but said it's on track to meet the full-year forecast. Meanwhile, the company added more monthly phone subscribers than expected. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
City. In London, in Sydney. From Washington. In Tokyo. 9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there to kind of upside.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Our expectation is that they have to cut more aggressively, that you get a recession, the unemployment rate rises. We have 225 basis points of cuts between Q1 and Q3 of next year. There is, no doubt a gap between us and where the Fed is in the market at the moment by the end of the year, but that gap's been diminished.
Matt Lazzetti, the chief U.S. economist over at Deutsche Bank, has been absolutely brilliant. The Federal Reserve getting closer to Matt's view of the world, rather than Matt getting closer towards the Federal Reserve's view of the world. And Matt Lazzetti yesterday, Lisa, keen to point that out.
Yeah, although I asked him, every day do you wake up and say, yep, still agree. Still agree with myself from yesterday. It's become sort of like slow-moving game of faith, where basically you can stick with your viewpoint and you're not going to have it confirmed for months. And it's a pretty aggravating place to be.
Early May, the next move from the Federal Reserve expected to be 25 basis points. They'll have this senior loan officer opinion survey in hand potentially, Lisa, and maybe they can share some of that with us, because that's the clarity around bank lending that I think we all want at the moment.
So basically they're gonna break the embargo on May 8th and basically give us a sense. And this is what everybody wants to know, right? Do they have the insight into how quickly things are changing? We haven't made enough of the Fed Beige Book, and I know that Tom doesn't read it, and that's not the reason why he's out today, so that he can read through it. But I do think that it's notable how much of a stagnation you saw in growth, how much of a slowdown in inflation you saw reflected in a number of different regions. This speaks to what we're hearing on the margins from the likes of John Williams and Austin Goolsbee.
Bear in mind, there is division within the Fed. The Fed staff are saying recession.
Right.
And Fed officials are not saying recession.
They're saying it's a possibility. The staff is saying it's very likely. It's a difference.
Do you think that maybe the Beige Book fits in there as well?
Yeah.
It speaks to some of that?
The staff is looking at what the Beige Book is looking at, and that is something that is a lot more negative.
Yeah, negative right now on the S&P 500, down 0.7%. Tons of earnings this morning, lots of banks, lots of Fed officials through today going into the weekend. Let's talk about the banks, and we can do that with Christopher Marinac, the Director of Research at Janney Montgomery Scott. Christopher, wonderful to catch up with you, sir. Thanks for taking some time, because I know how busy you've been this morning, just going through bank after bank after bank. Chris, what jumps out for you this morning from the names you've looked at?
So the banks are profitable, and you see tangible book value and tangible capital growing, so we're happy about that. I think deposits have been mixed. Some company deposits are off slightly. Really, deposit outflows were a lot less problematic than I think feared in March. So the real numbers suggest that deposits are coming down, but really coming down at a measured pace. I think liquidity is still really high, and I think banks are now putting out a bunch of information about the uninsured deposits, about office real estate, about deposit granularity. So I think that really starts to build confidence. We have credit quality generally very good for the quarter. No major change, maybe small upticks in charge-offs, but overall the banks are preparing for the recession if and when it comes. And I think capital generally is moving in the right direction.
Christopher, if this is all positive, then why are the shares negative, even after all of the losses that we've seen so far this year?
So I think the banks still climb the wall of worry about the recession, and many investors remember how bad it was in 2008, 9, and 10. So we have to get through this period, no different than the uncertainty that existed back in COVID in 2020. It took the banks 6 months to finally recover and go back to better valuations, and I'm afraid that might be the case again this year. We're hoping it's more like 3 or 4 months and not 6. But the reality is banks still have a lot of unrealized security losses and held to maturity and available for sale. We haven't worked through all those yet. We still have a lot of investors kind of haircutting capital for those losses. And I think at some point we have to get through that and see better securities values in the quarters ahead. But in the meantime, credit is stable. We think overall the banks will stay profitable, and the fears about big deposit outflows and deposit runs really have not proven to be true.
Although we are seeing net interest margins come in below estimates pretty much across the board. I mean, even Synovis, which just reported, and they came out with better than expected deposits, better than expected loan growth, fewer than expected provisions for credit losses, and yet here we are, once again, net interest margin coming in lower than expected, 3.43% versus 3.51%. Is the takeaway just that the profitability case for these banks has been severely challenged and will continue to be going forward?
I would say it's not severely challenged. I think it's modestly challenged, and some of that is really just a catch up on the cost of funds. Most banks' deposits are way behind the Fed funds rate. It's about 300 basis points wide. It's as wide as I've ever seen it in 30 years covering banks. So I think that's going to narrow in the next few quarters. So that catch up has definitely hurt margins, but I think the repricing ability of new loans is still very good for the banks. A lot of new loans are coming on in the high 6s, low 7s, and that's going to actually help margins stabilize. So margin declines are real at the moment. I think there's more of them in the second quarter, but I think the downside risk is not as bad as investors fear. But again, we have to prove this to investors. A lot of folks are from Missouri that want to be shown that this is really true.
It's about upside potential as well, not just downside risk, as you know, Chris, and you alluded to some of this just briefly. The threat of regulation from here, do you think that threat of regulation is going to keep people away from these banks despite whatever happens with the fundamentals in the months to come?
Sure, and the reality is that I think we still do not know what's going to happen with FDIC deposit premiums. The Fed and FDIC are very slow to approve bank deals. That's grinding, and we have a possible change in the White House, which really impacts regulation here in the several quarters from now. So that is a very good reason not to own banks. But I also think there are a fair amount of investors who have to own some position. They can't be at zero. They may be underweight, but they can't be at zero. So I think you're going to see some nibbling on the stocks as time passes. But there are a lot of folks on the sidelines. I think your point's very accurate.
There's a lot of economists who are looking for this data that comes out in early May, the Senior Loan Officer Opinion Survey, Christopher. And I wonder if we can sort of front run that a little bit based on what we've heard from the banks so far. There are people who sit around this table with us, Chris, every single day that talk about the beginning of a process that leads to tighter financial conditions and tighter lending standards. Are you hearing that from executives from these banks that have reported so far this week?
Absolutely. I think we heard it in January before all of this started to happen. So it's very much a reality. It will continue to get tighter. But the good news is there are companies who have to borrow and banks who want to lend to them. They're just going to be tougher on the standards. I think that actually bodes well for credit quality through the cycle. Loan to values are going to be lower than folks realize. I think the rates that people will accept from banks will be higher. That's ultimately good for business, but there's no doubt it's a tighter credit market out there. And what happened the past 6 weeks has certainly put an exclamation point on that tightening.
Have you gotten a sense, based on what we've gotten from earnings, of how significant the roll-up will be, of how much there will be mergers and acquisitions and a consolidation to become a larger regional bank rather than just a smaller one?
So I think there's always winners and losers in the bank space, and I think consolidation will continue to happen. Even if the regulators take their slow time to approve deals, we'll still see consolidation over time. So what I'm looking for is the strongest companies will start to raise capital to prove they can. That will differentiate them. That will help their stock prices recover sooner, and that ultimately will lead to consolidation. There definitely will be a difference between buyers and sellers on valuations, even though it may not seem it today. I think that differentiation will start to happen in the next 6 to 8 weeks.
Chris, as I say, I know you're super busy this morning, so thanks again for carving out some time for us as you pour through these bank earnings. Christopher Marinac there of Jenny Montgomery Scott on the latest with the financials. Lisa, how much do you think these banks need some clarity around the regulatory issues before they go around making deals?
I just don't know what kind of political pressure there's going to be to really increase regulations on banks that already are pressured on other levels with respect to competition from the big banks, because who's going to want to, basically give a cold shower to their regional bank that caters to their constituency? I mean, that's going to be political fireworks and dynamite. I mean, this is not good for what they want to accomplish.
Well, you've heard from the politicians repeatedly over the last month. They want to preserve regionals. They want to preserve this, and they're worried about creating a two-tier system. And I would say, well, don't worry about it. It's already happened.
Right.
Haven't we got just a two-tier system now?
And that's the reason why I found it really interesting. Bill Dudley wrote a column yesterday about the Fed's report that they're going to put out on what happened with Silicon Valley Bank in the aftermath. And he said he wants to hear from the Fed in how they kept rates low for so long, and then they raised them so quickly, and how that threatened the model in and of itself. And that was one big reason why that really undermined a specific subset of financial institutions. I just wonder if we're going to hear anything more of that nature from politicians, rather than regulating further some of the regional banks that are in their districts and that people love.
You know why I'm smiling? Because his successor, John Williams over at the New York Fed, said, no, don't look at us.
I know.
It's not because we went from 0 to close to 5 in 12 months. It wasn't because we were late. We were front-loading. We weren't late. We were front-loading.
Look, this will be in the history books, and we'll have to see. Nonetheless, the fact that banks were pushed to own the safest assets, which were treasuries, and then those treasuries dramatically changed in valuation over the following 12 months, created a pressure that was not modeled and that had not been anticipated, perhaps, and had not been prepared for. The fact that banks did not hedge against some of the losses on their treasury books, and they actually took hedges off heading into the end of last year, tells you everything you need to know.
And perhaps more importantly, weren't stress tested.
Yes.
For some of that.
Yeah.
Regulatory failure, as Mohammed Al-Erin has said repeatedly. We're going to catch up with Mohammed a little bit later. I'm sure he's going to have some things to say on all of this. We'll do that in about an hour from now. Up next, Liz Young of SoFi. Looking forward to that conversation as equity futures back away. Back towards session lows. We're down about 0.75% on the S&P 500.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed obviously can raise short rates to whatever level they want to get to, but the more they raise rates, then they're going to have to defend that position.
The Fed has already told us that tightening lending standards, in their opinion, will substitute for rate hikes.
For now, the consumer is resilient. For now, we're managing to process 5% rates, and therefore, for now, the economy is cooling and not cratering.
We've been really skeptical about inflation being able to get back to 2%.
Our expectation is that they have to cut more aggressively.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
One final time. What a mess, the Bowman, Logan, Boster, Carter, all coming up a little bit later.
You've got to do it again. Come on, that was so fantastic.
No,
I love it.
We're done. Fed speak through today into the quiet period. Going into the weekend, I think we're all done with it. Bank earnings a little bit earlier this morning. We can talk about that. We also need to talk about this, still to come. Later on this morning, 10:15 Eastern Time, you're going to hear from the Treasury Secretary, Janet Yellen, and she's got some things to say about China and national security. This is what she's got to say according to prepared remarks that we've got in hand. National security is of paramount importance in our relationship with China. We will not compromise on these concerns. She goes on to say, even when they force trade-offs with our economic interests. This so far, Bramo, I've got to say, quote of the morning goes to the Treasury Secretary.
Without a doubt, especially given that this really will pressure this sort of narrative around fragmentation and potential inflationary input as a result. I mean, honestly, this just goes to the soup, and we keep talking about the soup and the exhaustion of, the nursery rhyme of Fed names. This question of we don't know the new paradigm that we're entering into if we do get these sort of geopolitical fissures that Jenny Yellen is talking about.
They don't know either. They've implied one dot based on a median dot in their dot plot in the summary of economic projections. They're saying one more hike and then hold. Look at the range for next year in the Fed forecast. The range is pretty wide. from Fed officials. And the wider that range gets, the more it tells me they've got no real opinion on the Federal Reserve on where this is going next year.
They don't know. We don't know. Looking at the bank earnings, we thought that we would get some clearer read, and we got a slew of regional banks this morning. And the read is their deposits are costing more. Their net interest margins are going down, and there is still a real question, and Julian Emanuel said this earlier, there's still a real question about how much this will restrict credit and really substitute for some of those potential rate hikes.
That's the number one question, has been for the last month. Still don't have an answer. The good news is you haven't had terrible news around some of these smaller banks, that we seem to have moved on from that phase of stress a month or so ago. The disinflationary bust that the bond market initially priced, we've backed away from. I went through the range on a 2-year. The pre-SVB high was north of 5%. The post-SVB low was something like 350 on a 2-year yield. And we're somewhere in between right now. And that's what it feels like.
You know, I love the next guest that we have coming up wrote in her note that basically the more that you try to find some sort of fundamental reason for the melt-up that you've seen in stocks this year, the more you kind of are at a loss, because all of the negative earnings surprises, the potential weakness, it's all there. I mean, it's really, you can pick your narrative, but you can also really show exactly what people were expecting. And yet here we are with a resilience, and I just don't understand it. And that frustration is just leading into malaise of just sort of, well, what matters?
1 hour and 27 minutes away from the opening bell, with equity futures down about 0.8% on the S&P. I mean, I'm almost laughing. What matters? What was that about, really?
I think, look,
a question about life.
I think that it's just an exhausting role of like one year after another encapsulated in week after week.
Deeply philosophical, truly what matters. What matters?
Let's just keep going.
Is Liz Young still with us? I hope she is.
I think
the head of investment strategy at SoFi. Liz, great to have you with us. I'm just going to go straight to your own question. You say, what gives? Is this the calm before the storm, or a durable momentum to the upside? Which one is it, Liz?
Well, I thought we might keep talking about the meaning of life. I was excited for that conversation. So I do not think that this is durable momentum to the upside, but I want to recognize the fact that there has been decent momentum really all year in stocks, despite all of the headwinds and the backdrop of this uncertainty and negative news that has happened since January 1st. So what I think is happening right now, and what I think happened before this, was we obviously saw a big move down in rates, both the 2-year and the 10-year. We saw obviously that inversion between the 2s, 10s get to its deepest level, but then really bounce back to more of a flatter curve, if we can call it flat, at 50 to 60 basis points inverted. And now what you're seeing is this sort of march back up in rates that is pressuring stocks a little bit. So if the rally coming into the year was predicated on the idea that, okay, rates down means good things for stocks going forward, then we're probably giving some of that back right now, and there's a bit of fragility to that story. The other piece, as we obviously know, is that earnings season is now well underway. And we started off with, I think, maybe some calmness from the big bank earnings and the fact that they didn't report anything surprisingly negative. And that was a nice way to start earnings season with a sentiment boost. But now we get into the meat of it, where we're going to hear from smaller banks, regional banks. I don't think anybody expects that news to be positive. But I think the biggest part of earnings season is actually going to be the tech reports. And the reason I say that is because we know that tech companies have done a lot of cutting since the end of last year, early this year. This is when we start to find out if they cut enough to preserve their margins and to offset the declines in revenue that we expect for 2023.
So just to go through the calendar, Apple in early May, Microsoft April 25th, Google April 25th, Amazon April 27th. Meta, of course, has made a ton of cuts and has had a fantastic year to date on that stock. Liz, what are you anticipating? What's the answer to that from your perspective? And what's the risk based on what we've priced?
Well, I think the risk is that those companies have been rewarded for cutting, which I think was smart. Those are fundamental reasons for looking at a stock and saying that it maybe has some room to move upward. So they were rewarded in the market for cutting. They've also been rewarded, as I mentioned, by falling rates. So if we go into a period where rates are higher and we expect rates to stay that much higher for a longer period of time, and we find out that revenue has pressured their margins more than we expect, that's where the risk to valuations comes in. And if you look just at the broad index trading at about 18.2, 18.3 times forward earnings, that's above the 10 and the 15-year average. That 10-year period was spent with 5 years at 0 interest rates and with a 10-year treasury at about 2.1% on average. We're obviously in a different environment right now. The other thing I would say to people, and I wrote this in my note this morning, is that if you are looking at this and thinking, what could it be a new bull market? Could it be a bull market that's coupled with a new economic expansion? You want certain signals to be sending off positive alarms, and we're just not seeing that yet. So things like the copper to gold ratio, you want to see that rising if this is an economic expansionary environment. That's not happening. That's actually falling. And things like small caps, you want to see them participating in a market rally. That's also not happening. Small caps have lagged quite a bit. So there aren't signals that are sending off this sort of early bull market, early economic expansion signal, which is why I can't get to that side and get positive on this being a buy right now.
Do you have any sort of trade secrets that you get from the other side of the SoFi business, which extends credit to individuals, about how much that could potentially be constrained, how much people are failing to pay their bills or continuing to do so?
Well, for obvious compliance and legal reasons, there are a lot of firewalls between me and certain parts of the business. But what I will say, broadly speaking, on the industry is credit was tightening before we had the regional bank headlines in March. Now you should expect it probably to tighten more as the year goes on. Also, this piece about commercial real estate, some of the defaults that have happened, and some of the expectations for possibly further defaults this year is not something to be ignored. It is, however, something that isn't quite making it into the consumer narrative. People don't on Main Street necessarily talk about commercial real estate and that sort of business-to-business lending, but that is something that I think is going to continue to put stress on the system. And I would expect, as the year moves on, credit spreads, both on the high yield side and the investment grade corporate side, to get wider and start to match up with what we expect to see as stress in the system.
So then where do you park money if you're going to be conservative?
Yeah, and that's one of the things that if you're bearish or cautious in this environment, you sort of get accused of not being invested, and that's absolutely not true. It's just that you should be invested in things that maybe don't sound as exciting and things that you don't talk about in a regular environment. So I would still have money in equities. I just wouldn't be overweight equities here, and I certainly wouldn't be overweight rate sensitive or economically sensitive parts of the equity market. But you can still have money in short-term treasuries. As we've seen this march back up in rates, you get another opportunity to put some money in short treasuries. And what I mean by that is anything shorter than 3 years. You still have the opportunity to put money into gold. I think that you see probably some more upside in gold if stress does hit the system. And obviously there's still cash that are interest-bearing cash accounts like money market funds. And if you don't have an allocation to some of those defensive sectors in the equity market, I think utilities are still an okay place to be, or something that's going to pay a dividend so that you can get paid while we wait out this uncertainty and find out whether or not there will be some sort of landing sometime later in 2023.
Les Young, thank you, of SoFi. Some kind of landing. Soft, hard, no landing. No landing's off the table now. I've got,
Soft
honestly.
crash.
Honestly. Drives Liz nuts, drives us all nuts, doesn't it?
Soft crash.
Whatever.
Crash lightly.
Liz, thanks again. Liz mentioned gold. Gold's just clinging to 2,000. A lot of people are waiting in gold. Very close to a record in the last week or so.
And people have talked about the divergence between gold and Bitcoin for a while. Bitcoin was considered a store of value akin to the precious metal of gold, and yet it has diverged. Also, though, interesting to see some of the other commodity sectors that you would think would get a boom from China's reopening that haven't. And I think people are looking at that. Yesterday, for example, oil prices declined and are continuing to do so today on the heels of an expected decline in activity in the United States, even though you have that reopening, even though there are some, bright shoots even in Europe.
Equities session lows on the S&P 500 down 0.8% right now. Tesla down more than 7% in the pre-market. Earnings yesterday after the close from Tesla, margins lower than anticipated, or rather, I would say expected directionally to head this way because of what happened with the price cuts, but the magnitude of the move lower, bigger than a lot of people expected. That means the stock is down. And here's the take from a bull this morning. And I'll catch up with Dan Ives a little bit later over at Wedbush. With no rose-colored glasses, margins are now a delicate issue that are keeping Tesla investors up at night. The stock is down by almost 8%. Coming up a little bit later, Seth Carpenter of Morgan Stanley is coming up this hour. Looking forward to that conversation shortly as we count you down to jobless claims 20 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and other allies of Ukraine may ramp up the economic pressure on Russia's President Vladimir Putin. Bloomberg's learned they are considering a near-total ban of most exports to Russia. A group of 7 officials are discussing the idea ahead of a leaders' summit in Japan in May. The aim would be to include EU nations in the crackdown. Outside Paris today, protesters angry over French pension reforms stormed the entrance hall of stock exchange operator Euronext. Now, railway workers and others chanted, set off flares, and waved union flags. Euronext says operations were not affected. Anger over President Macron's decision to raise the retirement age from 62 to 64 remains strong. Democrats are rejecting House Speaker Kevin McCarthy's proposal to raise the debt limit for about a year and cut government spending. The plan would increase the debt ceiling by $1.5 trillion. It would also cut discretionary spending by $130 billion. If the debt limit isn't raised, the U.S. would default on payment obligations as soon as June. Bloomberg's learned that secret recordings by a fired Fox News producer helped push the network to its settlement of a defamation suit by Dominion Voting Systems. Fox lawyers feel that the recordings made by Abby Grossberg and her testimony would be used against Fox chairman Rupert Murdoch and other witnesses. A Fox spokeswoman calls the account of the recordings widely inaccurate. And home builder D.R. Horton reported better than expected orders in the first quarter. Tight supplies of existing homes drove buyers to builders' sales offices. While D.R. Horton's orders dropped 5% from a year earlier, they were still 73% higher than in the previous quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The Fed has already told us that tightening lending standards, in their opinion, will substitute for rate hikes. They don't quite know how many, but their best guess looks to be a couple, because those two-year yield highs that you refer to above 5% came hot on the heels of Jerome Powell suggesting they may go back to hiking by 50 basis points.
This is a calibration question, a wise man once told me, and that wise man is Seth Carpenter at Morgan Stanley, and he's going to join us in the next 10 minutes. That was James Athey, the investment director over at Aberdeen. Let's get you some price action going into jobless claims. Welcome to the program if you are just tuning in on TV and radio. We get some economic data in America in about 13 minutes time. Jobless claims, and jobless claims have started to climb recently, and it's something to keep an eye on. Mike McKee's going to run through that for us in just a moment. Futures are down near session lows, off by 0.8%. Tesla, margins disappointed. Inventories ticking just a little bit higher. The stock is lower by almost 8%. That's dragging some of the NASDAQ down too. Tesla down by 7.7%. And in the bond market, yields are lower by 3 basis points. The 2-year, 4.21. The 10-year, 3.56. One more for the people in the back, Bramo. Waller, Mester, Bowman, Logan, Bostic, Harker, a little bit later.
You said you were going to do it. You did it, and it was fabulous.
Just
Thank you.
one for you. No worries.
Aww.
It's a quiet morning, isn't it? Nothing to talk about.
You know, honestly, these regional bank earnings have been so fascinating to me, and the read-through in markets, to me, tells you so much. That, paired with the Tesla news, gives you a sense that this earnings season might be different, and it might be a slow drip that builds to something more. I do wonder how much people are coming around to that kind of idea.
Well, it goes back to what we talked about yesterday. There's a difference between saying this was a one-off event we can leave in the past, or this is the beginning of a process. And I sense that the consensus believes it is the beginning of a process, that we can leave this shock behind, perhaps. Some people might want to call it a crisis. Can leave that behind for now. But there is a process that started here, and we still need some clarity on it. And I think all those Fed officials we've joked about this morning, they need the same degree of clarity as well to make decisions beyond May through the rest of this year.
Which they're asking for, and they're acknowledging that they don't have that clarity. At this time, though, I do wonder how much on the risk-taking side people are saying, look, it hasn't happened yet, and things still look okay, so why not keep buying? And I do sense that there is this divergence that's continuing between stock and bond markets.
Mike McKee with us around the table. Mike, good morning to you.
Yeah, good morning.
Get some data in about 12 minutes' time. We'll talk about jobless claims. We'll talk about Fed speak. We need to talk about the debt ceiling. So tax day was earlier this week, and that usually means we should get a better idea of when the Treasury's going to run out of money.
Yeah.
When does the Treasury run out of money?
Well, the Treasury has said around June 5th, depending on tax collections, and tax collections came in weak. $108 billion was added to the Treasury general account as of Tuesday. And so that's maybe not enough to get us past that X date. There was a thought if we got a significant addition that they might be able to push it back into August or not. But now this brings forward planning for people on trading desks. It brings forward questions about what the Fed will do, and obviously is going to raise questions about what Treasury will do. Now, we have to wait through the end of April to see what other kinds of revenue come in. But now we're basically hearing from analysts that we should have a pretty good idea by the 1st of May.
Does Treasury have any levers they can pull right now to push that date off a bit?
Not right now. There's a few things they could do starting in June. And in June 15th, we get another infusion of tax money, quarterly tax payments, and that could push it back farther out. If they can get to June 15th, that's going to be the question. And one important thing that people don't realize is X date is not a day. X date is when the Treasury feels there's a good chance it can't pay the bills in the next coming days. So it's a moving target. It isn't going to, they're not going to say June 5th, but it could be that week if that's what they're worried about.
Mike, before we get to our next guest who's coming up, I'm curious from an economics perspective what the implication is with respect to some sort of debt ceiling debate that will inevitably lead to some reduction in spending. The sort of fiscal drag that people talk about, but some say hasn't fully been appreciated.
Well, there will be a fiscal drag. The question is how much do they take away from spending? Now, the Republicans are proposing a 1% cap on domestic spending going forward, which would be something of a drag, but not as bad as what would have happened had they insisted on a balanced budget plan over 10 years. But they also want to cut back on the Investment Reduction Act, which is really the green stuff that the administration put into that bill. And that would be a significant drag over a number of years as that's spent out. The thing about the Republican plan is that McCarthy was talking yesterday about how much this would save. Nobody has scored that yet. This bill has to go to the CBO and to the Joint Tax Committee, and we'll see what they say about what it would save, if it would save anything.
I've always sensed, Mike, that the public in this country are often misled around this issue, that this is about spending already agreed.
Yeah.
And I know you find it frustrating as well, but just because you make that point around the debt ceiling does not mean that you don't think debt sustainability is an issue and should be discussed. And I always find that that's the way this conversation often goes. If you start to say, no, you should lift the debt ceiling because this is spending already agreed, you then set off a bunch of people who say, well, you don't care about debt sustainability. And I'm like, whoa. You need to separate these two issues. And I think we've really struggled to do that in this country, Mike, for a long time now. How do we change that?
We have. Well, the hard part is both sides have to give up the political effort to gain advantage.
It's not going to change. Just so you know.
I guess that's the bottom line.
Yeah, I mean,
the administration has said they're willing to talk about it. They know there's a problem. Obviously, it's not sustainable growth, what we have seen, and we're going to have problems with entitlement programs in a shorter period than people anticipated. And so something has to be done. The question is, do you sit down and hash out an actual plan, which has been done before? I go back to 1990, what was it, 93, 93 with, 89, George W. Bush. H.W. Bush sitting down with the Republicans and Democrats sitting down at Andrews Air Force Base. It was called Andrews Air Force Base then, and coming up with a plan. That was the read my lips, no new taxes backtrack that he did. But they did go off and they did come up with a something budget plan. And in 2011, they came up with a sequestration plan. So there are things they can do, but they've got to stop blackmailing each other.
Is that going to stop Bramo? Bramo doesn't sound hopeful at all.
I mean, I love your optimism.
Well, I'm not optimistic about changing it. Just I think we've got to be better about consistently framing the issue at hand here. And Mike's been great about that over the years. Mike, stay close. Jobless claims 7 minutes away. With us now, Seth Carpenter of Morgan Stanley. Seth's going to stick with us through that economic data. Seth, good morning to you. Can we just start with claims, anticipating that data? Starting to climb a little bit higher recently, Seth. There is a trend there that you and the team have identified that you think we need to pay attention to.
So obviously you always want to pay attention to data. You got to look, though, not just that it's trending up a little bit, but also the level, and the level stays very, very low. I think it's hard to get away from the fact that the labor market is still tight. The jobless claims are useful. If they if they keep this upward trend, we'll be paying attention to it. But so far, I think the level is more important right now.
Seth, we heard from the Beige Book yesterday that there was this softening in the labor market. Where are they seeing that if it's not in some of the jobless claims that we keep getting?
So the Beige Book is great because they have people in each of the 12 regional banks, and they're talking to folks in their districts and really trying to make sure they have their hands on the fingers on the pulse in the districts. I do think we're going to want to keep looking at the non-farm payrolls data that come out at the beginning of each month. We're going to want to look at the employment data from the household survey. Those have been slowing. They're still robust, but the direction of travel, I would say, is pretty clear that things are slowing down, just at a pretty strong level.
Seth, that data 5 minutes away. Stay close. We'll break that down with you in just a moment. Mike McKee's going to be with us as well. Mike, have you got a final word on that? What you're looking for from claims in just a moment?
Well, we're looking to see it rise a little bit, but not a whole lot. And as Seth said, the level is what matters. We had a big jump up because of the change in seasonal adjustment, but does that flatten out now?
This is how the next hour is going to look on Bloomberg TV, Bloomberg Radio. On Bloomberg TV and radio, we'll break that number down for you in about 5 minutes. Mike McKee, Seth Carpenter. In the next hour on Bloomberg TV, here's your lineup. Mohammed Al-Arian with us for the hour in a studio here in New York of Queen's College, Cambridge. Brian Weinstein of Morgan Stanley. Mona Mahajan of Edward Jones. Dan Ives of Wedbush on Tesla. Tesla having a difficult morning, Lisa. A better year, a difficult morning.
What a great lineup. And the interesting thing is that Tesla is very much of a macroeconomic story in addition to a very specific one. And I'm sure that you'll parse it out with some really incredible guests. I'm looking forward to
Looking forward to it. Looking forward to Mohammed anchoring and me taking a break. As is often the case. Mike McKee knows it. That stock's down almost 8%. Futures down by 0.8% on the S&P 500. The opening bell about 64 minutes away. Jobless claims in America coming up next.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz just moments away from initial jobless claims, which we are expecting to tick up. Not a lot of drama, but definitely a softer tone in markets. We're seeing the NASDAQ down, futures down about 75 basis points, and you could see that underperforming S&P futures. The Russell actually underperforming even more, which tells you something about where we are with the regionals. You can see a bit of dollar strength, the euro 109.40 after a lot of potential weakness, and yields coming in just a touch. Crude, a very interesting moment given the ongoing pessimism around economic activity. And we are getting that data. Michael McKee of Bloomberg Economics and Bloomberg Television here with us. Mike, what do we see?
Well, we see a little bit of a rise in jobless claims, 245,000 from a prior release of 240,000, revised up by 1. So not a major change. And again, I'll steal a little line from Seth Carpenter. I know you can ask him about it. Sorry, Seth, but it is important that we can talk about how the level is what kind of matters too. We had a jump up in jobless claims a couple of weeks ago, and now we're seeing some move upward, but not a very big move. The continuing claims numbers come in a little bit higher, 1,865,000 from 1,804,000. So that kind of fits with the last 2 weeks of moving up in terms of claims. Now, the Philadelphia Fed business outlook is very interesting because it comes in at negative 31.3, which is down from negative 23.2. The new orders index is at negative 22.7 from negative 28.2, moves up just a little bit, but still very negative. Employment, negative 0.2 versus negative 10.3. So maybe there's some manufacturing help in employment. And the prices paid index is 8.2 versus 23.5. That has to be, I haven't looked immediately, but that has to be a low for quite some time. So some good inflation news as the Philadelphia Fed points us also to the idea of the economy slowing, Lisa.
Michael McKee, thank you so much. We are seeing a reaction, certainly in two-year yields in particular, of falling to 4.16% on the heels of this data. You're seeing it across the curve. 10-year yields also lower, 3.53%. Equity markets keeping some of the losses. Interesting to see a slight bounce back in the NASDAQ futures. Simply, could this be this sort of bet that perhaps fewer rate hikes is a positive thing? Let's bring in Seth Carpenter, who has been quoted so frequently this morning on this show, Chief Global Economist at Morgan Stanley. Seth, what's your initial reaction to these numbers?
Yeah, the tick up, I think, is there, that there is a bit of softening. We've been saying for a long time, I think everybody's been looking for some softening in the economy as this year progresses, and I think that's what we're getting. The level is important. It's still quite low, so it's not as though we've fallen off a cliff or anything like it. I think the market reaction that you cited is also important. You know, we have one more rate hike as our baseline forecast at the May meeting, and then none after that. And I think the market is going to have to sort out, you know, when is the Fed going to say the softening is there? It's enough softening without it being too much softening, and these data go in that direction.
So we get these data points, and then we also got earlier this morning, and we'll get throughout the day, the regional banking results, which have also pointed to potentially some withdrawal of credit. How do you factor that into employment? How do you factor that into the Fed's decision?
The banking situation is clearly important. It tightens financial conditions. It tightens access to credit. But we have to keep in mind that tightening access to credit and tightening financial conditions is exactly what the Fed has been trying to do since they started raising interest rates. The hard part is, how much is this? Chair Powell at the last meeting, at the March meeting, said maybe it's about 1 or 2 rate hikes worth of tightening. I'm not sure we've got much data since then that says that he's wrong about that. It clearly matters. It clearly has increased cost of funding for banks. But we haven't seen it look like things are going off of a cliff. And so it's marginally more tightening, which again, for us is the reason why one more hike makes sense, but we don't need to go back to the place where the markets were pricing at 6% peak rates for the Fed.
There's this tension right now when you talk about the lag effects that will take place as some of the credit tightening continues at a time when you're already seeing deterioration in the labor market. Do we have a sense of how controlled this increase in unemployment could be? Are we just going to go to 4.5% as the Fed is predicting and stay there? Or is there a risk that it will accelerate on itself, which is traditional in downturns?
Risk, absolutely, and the amount of control that the way you phrase the control, that's what the Fed is hoping for, but it is impossible to believe that they have a huge amount of precision over these sorts of things. They're going to be feeling their way. I think what might be instructive for this cycle is to go back to the 1990s. That hiking cycle was pretty fast, like this one. It changed pace. They stopped hiking at one point, and then they actually cut a little bit. They did a mid-cycle correction, if you will, cut a little bit, and then held rates high for several years after that. I think that kind of recalibration is entirely possible precisely because there's not going to be a lot of precision over the real economy.
As we talk about the destination, that was one of the big comments people at the IMF had, that whether they were on the side of the IMF or not, that we're going back to where we were pre-pandemic. Based on some of these additional views with respect to credit tightening, with respect to potentially overshooting with the pace of unemployment creeping higher, do you think that that is the highest likelihood, that we are going back to a low inflation, low rate situation?
I'm not convinced that that's the single most likely outcome, at least not for the next few years. Is there a possibility of a recession? Absolutely. The risks are clearly higher than they were before. However, I'm old enough to remember when we've had recessions in this country without the funds rate going back to zero. And I suspect even in that version, it's not our baseline that we have a recession, but even if we did have a mild recession, I don't think they're going to cut all the way to zero.
How does the geopolitical overhang factor into this? And I say this as Treasury Secretary Janet Yellen is set to speak in less than 2 hours and talk about how they're going to put national security before economic influence. How much does that factor the fragmentation and the higher inflationary regime going forward?
Oh, it just adds another layer of complexity and difficulty in forecasting. When it comes to the inflationary side of things, if we disrupt global supply chains, it does mean that any surge in demand won't be met with as much supply or as quickly with the supply. And so it could lead to more bouts of inflation. I don't know that it necessarily means we shift into a permanently higher inflationary regime. That's going to depend on whether or not the Fed can control the economy, rein in aggregate demand to keep inflation from staying high. But ultimately, it will make things more volatile. You'll see more macroeconomic volatility.
We've been talking about all the Fed speak that we're going to be getting today, jamming it in ahead of the quiet period. What do you hope to learn from Fed speakers?
As always, it's a question of what is it that they're looking at. I have consistently had the view that they are trying to slow the economy but not kill the economy. And so the real question is the softening that we're seeing in the labor market, just like we were talking about before with the initial claims data, is that softening enough for them to say, we'll stay roughly where we are? Like I said, our base case is one more hike. Are we seeing enough downward momentum for them to feel comfortable that the economy is slowing enough inflation to continue its downward trend and for over the next couple of years to get back to target.
Seth Carpenter of Morgan Stanley, thank you so much for being with us. As always, fantastic to get your insights on a day that is highly confusing, and the clarity is greatly appreciated. Right now, I've got to say, we've been talking about all of the earnings and the potential stress in the banking sector. Sonali Basak is joining us now ahead of an interview with somebody on the other side, potentially, of this, John Gray, who is president and COO of Blackstone.
Yeah, absolutely. John, thank you for joining us so much, because you have such a large place in this story when we're looking at lending contracting across the country in so many ways. But let's start with your results here, John, because when you look at the numbers, you've beat on earnings per share, but assets under management, we've been waiting quarter after quarter here. You're so close to hitting that $1 trillion mark. You've said things are kind of slowing out there in the environment. At what point do things start to turn around here to kind of help push Blackstone a little bit further in this environment?
Sonali, it's great to be with you. I would just say we're incredibly proud of the quarter. We protected investor capital, and that performance is ultimately what's going to propel us forward to raise more capital. We did see $40 billion of inflows, more than $200 billion over the last year. And for our shareholders, we delivered nearly $1 in distributable earnings despite limited performance fees. And we really think we have the right model. We've got staying power where we can hold assets in a difficult period, and firepower, nearly $200 billion to deploy. So our view is we just keep executing for our investors, and the assets will take care of themselves over time.
Now, we want to look a little bit broader across the universe here, because Blackstone, of course, is one of the biggest private landlords in the country, everything from warehouses to single-family homes. I'm wondering if you take out your crystal ball, John, and kind of look across the economy. What are people not seeing about the real estate market? What's the next shoe to drop?
Well, I think on real estate, the issue is people are looking through a very narrow lens, and they're thinking about real estate all as one thing. And the reality is where you invest matters. So if you look at office buildings, traditional office buildings in the U.S., which fortunately for us are less than 2% of our portfolio, there we're seeing really unprecedented weakness. Vacancy rates are 20%, rents are under pressure, and valuations are under significant pressure. But if you look across to logistics, global logistics, which is 40% of what we own, there things look very different, almost unprecedented strength. You've got vacancy rates less than 3%. You've got rents growing double-digit, mark-to-market lease rates of 40, 50% between where the market rents are and what's in place. And so I think it's a pretty vast world out there in real estate. Hotels continue to exhibit strength, data centers, student housing. But yes, commercial real estate in the office sector is challenged, and we expect that'll continue for some time.
Has that unprecedented weakness, John, been fully priced in when it comes to the office space?
Well, I think you see it in the stocks of the public REITs. They've traded off very dramatically. Some of the big public office companies are off 50, 75%. You've seen in the private market valuations in the limited trades that are happening are down significantly. I think some folks, in terms of funds, private funds, may not have marked fully to what's been happening. I think you'll see more of that. We tend to be ahead of the curve on those things. But I think the good news is, because I know there's a lot of focus on the banking sector, is that leverage levels around commercial real estate going into this were pretty low. So I think banks probably lent against office buildings at about 60% of value, so they should have a pretty good cushion. And office buildings as a percentage of their balance sheets is pretty small. So it's an area where there will be real headwinds. Equity owners will take some real hits, but the broader real estate market looks a lot healthier.
How concerned are you, John, even in the broader real estate space, about some of the issues that we've seen in the small banks, given that they own a significant portion of the lending books to commercial real estate across the industries?
Well, there's no question that credit will be tighter to commercial real estate. Some of the good news is the agencies, the government agencies, Fannie and Freddie, lead the way in multifamily lending and apartment lending. There is strength in other areas. Real estate lending is broader than just banks because insurance companies, Commercial mortgage-backed securities exist. Mortgage REITs are out there. So there are multiple sources of capital. But I do think credit will be tighter in commercial real estate. The one benefit to existing owners is construction lending is going to get a lot tighter. And so you'll see less new supply. Long term, that's a positive. But yes, I think we will see less capital available. It will dampen things a bit. But ultimately, fundamentals around supply and demand are what drives value. And that's why I have confidence going forward in most of the sectors, certainly away from office buildings.
John, I'm really curious about an update here on BREIT, the real estate fund that has faced some withdrawals over the last couple of months. Performance has been pretty stellar over 3 years, more than 17%, but it has turned negative this year so far. I'm wondering what the pitch is to invest this year when performance is starting to be more muted.
Well, the performance this year, interestingly, Shanali, has been hurt mostly by the interest rate hedges we put in place to protect the fund, which really helped us last year. The historic decline in March in rates impacted. But if you looked at the performance pre those hedges, you would have had positive performance in the quarter. I think rates have now moved down a fair amount, so that headwind should be away from us. The other thing I'd point to is the cash flow growth. In the first quarter, estimated cash flow growth for BREIT was 9%, led by hotels, student housing, logistics, which we talked about. And so the underlying cash flow growth is good. It looks like inflation's getting under control. The 10-year has moved down, which long-term is a positive for this portfolio. So we feel really good. It's a portfolio of rental housing, logistics in the Sun Belt of the United States. Right. It's exactly what you want to own. And we think once you get through this more volatile markets period, people will focus again on fundamentals, and that'll be quite helpful for the flows in BREIT.
We started to talk about the banking market as it pertains to commercial real estate, but, I want to cite some of Bloomberg's own reporting here. Blackstone had been in talks with Valley to buy some assets from Silicon Valley Bank. I'm really curious what this says about your ambition in this banking kind of tumult period. Do you think you could do more by means of working with regional banks, providing more credit where credit is tightening up, especially given some of your private credit books are up more than 9% so far?
I think that's a great question, Shanali. Interestingly, of the $40 billion we raised in the quarter, 60% of it came in our credit, insurance, and real estate credit areas. Investors are allocating more capital. We have in total in those areas $350 billion. And so I think there's a real opportunity. We're actually in discussions today with a number of regional banks to partner with them. They have very valuable relationships with borrowers out there across the country. We have long-term capital, and so in consumer financing, in small and medium business financing, particularly in the asset-backed area, we think there's a real opportunity to deploy more capital. And I think it's one of the real strengths of the alternatives business. As you know, this used to just be about private equity, real estate private equity. But what we do today is much broader. And I think the private credit area is really at a golden moment because we do see tightening out there. And yet we have this large pool of capital to deploy. And so I think you'll see us become much more active.
John, do you think that private credit will come into its golden era at a time where private equity is fading, where the valuations make less sense at a time when rates are so high, and it offsets some of the potential equity valuation?
I think we see cycles. And so if you look at private equity, it's had enduring performance premiums. That's certainly been the case for us. Our group has done a terrific job deploying capital. What you're seeing now is a cyclical slowdown in transaction activity. That's what happens at moments when people are cautious. But ultimately, this recovers. And so our ability to find great businesses, to intervene with those companies, to partner with management teams, create value, that still exists. We announced a sizable public to private of a company called Cvent in the online event management space for a little north of $4 billion this quarter. I think you'll see us find more opportunities over time. I think it just says right now things are a little bit slower, but they'll come back, and I think that business is going to do quite well.
Hey, John, I'm really curious about your thoughts here on rates and inflation. You've heard a number of your banking rivals and peers say already that maybe the market is not really prepared for the eventuality of higher rates. And you've said also that maybe cuts this year are also not on the horizon. So what is the thing that the market is not seeing here about the direction of travel?
Well, I would say on the inflation front, I'll give you a little bit of optimism. We see inflation moving into the rearview mirror. And I say that because across our portfolio, the statistics are really encouraging. Our procurement managers at portfolio companies are saying inflation in terms of input costs was only up 2% in the quarter. Shipping costs have come back, almost back to 2019 levels. Even wages, which were up as high as 7% in our portfolio 6 months ago, are now at 5.6%. And the availability of workers has gotten a lot better for our portfolio companies. And if you looked at the CPI number last month, it was 5%. But if you exclude shelter, which is a lagging indicator, it was up just 3.4%. So that is the good news. I think the more challenging news to your question on rates is the Fed is going to want to make sure this inflation really gets down. So I think the idea that they're going to pivot is a mistake. I think they're much more likely to pause, hold rates at an elevated level, and continue to see the economy decelerate. And now when you add in what we've been talking about with regional banks, that's going to create further tightening. And so credit is becoming less available, more expensive. It's really, sort of the blood flow through the circulatory engine of the economy, and that is slowing. And I think that will lead to a sequential slowdown in the economy. So that will stay tight. But the good news for investors, for consumers, is inflation's coming down, and we think that's really positive.
John, 20 seconds. How long is it going to take for deal making to come back?
I think it's going to take some stability in markets, certainly getting past this inflation, people having more confidence. Hopefully it happens in the back half of the year. I think at the latest, sometime in the early part of next year.
John Gray of Blackstone and Bloomberg Sonali Basak, thank you both so much for being here. We've been parsing through the earnings all morning, and we can see the read-through has been somewhat negative when we take a look at the regional banks, with the Russell 2000 underperforming in futures markets. You could see the NASDAQ retracing some of the earlier losses, down 0.9%. The S&P still down about 0.7%. Yields lower on the heels of initial jobless claims coming out, a bit above expectations, as well as the Philadelphia index that came out this morning. You can see 2-year yields down at 4.16%, and that euro strength is actually reasserting itself. Basically bouncing around, but 109.72, as we have seen it kind of hovering around some of the highest levels of the year. Crude now turning somewhat negative, but we are seeing the VIX turn somewhat positive. Right now, just to sort of look through what we can understand from the banking results that we've gotten so far, Sri Natarajan joining us here of Bloomberg News. Sri, I just want to get your sense of, just starting where John Gray left off, about the deal making and how it's not going to come back in for some time. How much was that already anticipated in some of the earnings ahead of the big banks?
It's interesting, when we heard some of the big bank CEOs speak in the last couple of days, the David Solomons and the James Gormans, they were very clear that yes, deal making is challenged. That's obviously visible in the figures, but they were also hopeful that it will pick up towards the back half of the year, and that they're basing on the fact that there are a lot of encouraging conversations happening. Everyone is pulling out their strategy maps and figuring out what the roadmap ahead is for them. They don't want to execute on anything right now. That makes sense. There is still a lot of volatility, and you do not want to jump in the middle of that right now. But this is the time to plan, the time to execute, and therefore an increase in deal making is likely to come as we approach the end of the year.
One of the big distinctions between the haves and the have-nots was fixed income profitability at a time when some companies are starting to, or some financial firms are starting to withdraw how much risk they're willing to put out there to deploy to the balance sheet. How much was that one of the big drivers of the winners and the losers?
It clearly helped a lot of the big banks, the JP Morgans, Goldman Sachs, Morgan Stanley, Bank of America. All of these firms that have a good fixed income trading footprint benefited from the rates volatility that we saw. Goldman Sachs may not have met expectations, but it was their third best fixed income quarter in a decade. Citigroup, JP Morgan, Bank of America, all comfortably beating expectations, which tells you that was a big driver for them. And of course, it does help some of the larger consumer banks like JP Morgan and Citigroup that they can still talk of a fairly healthy consumer and a nice increase in net interest income going forward. That is also giving a lot of boost to their stock.
Have you ever covered an earnings season where people cared less about the big banks and instead favored the regionals?
It is remarkable, isn't it? We've seen one after the other, all the big banks report their earnings.
No one cared.
No one cared, and that's surprising because normally we're looking at them to get a sense for the pulse of the consumer, for the appetite of the big corporates. But this year, everything came in as expected, more or less, and everyone's turned their attention to the regional banks. The good news in the last 24 hours, we've seen a slew of regional bank earnings, and things are not really dire. Yes, earnings is going to be challenged for a lot of them, but it is not an existential threat for the vast majority. That seems clear.
Do you have a sense of whether some of the regionals have to pay substantially more to keep their deposits than the largest banks?
That'll certainly be a factor. Every single regional bank that has reported so far has obviously reported some level of deposit declines, some a lot more than others. Again, not to the extent that you have to worry about their ability to survive, but you certainly have to be worried about their ability to thrive. So yes, they will have to raise rates to attract deposits. That might still be challenging, and it will bring about a lot of opportunities for mergers in that space. Not necessarily the biggest banks going and buying some smaller players out there, but the tier 2s buying some of the tier 3s and consolidating that. That's a big unknown right now. That's the one bank that everyone's scared about because that stock that's down about 90%. It's not a tiny bank. It has a big hole on its balance sheet. There is no obvious solution on the horizon. Yes, people have said deals are possible, whether it is the government making a few tweaks to what is allowed and what's not allowed, or whether it's a really large institution that can withstand that $13 billion hole that exists in their balance sheet because of their exposure to that real estate mortgage market. We will be paying attention to where the deposit stands. We've seen a big flight of advisors from First Republic. Has that stabilized? Have those wealth managers, we've seen a few headlines, but is that just a few of them out there, or has that really led to a big trickle out? And what impact has that had on deposits will also matter. That's what we'll all be watching for on Monday evening.
Sri Datarajan, thank you so much for being with us. Also today at 4:30 p.m., you will get the update on the Fed's balance sheet as well as the deposit window and the recent emergency lending program that they came out with, which I actually do think will be really interesting. People look for this data at the end of each week and on Friday as well. Coming up on Balance of Power, Angela Stent, a really interesting conversation about Russia, senior fellow at the Brookings Institute, as we hear about some more potential restrictions on what the U.S. plans to export to Russia. We are seeing in markets softness as a lot of investors parse through what we got just now out of some of the banking earnings. The S&P down about 0.7%, 109.74 on the euro, and interesting to see that the VIX still very subdued at very low levels despite some of the angst out there. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, But that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. Tons of bank earnings, regional and small, and then a ton of Fed speak, with equity futures negative this morning by 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, squeezing in a ton of Fed speak before the quiet period. Tesla pushing for more volume, sacrificing profitability, and Yellen on China. Security worries top economic interests. We begin with the big issue: surviving, not thriving.
Yes, the regional banking crisis has definitely meaningfully abated.
Larger banks have obviously posted some very good results.
The question here is, where are the next dominoes likely to fall?
We're always looking towards what the next shoe to drop will be.
And I don't think anyone's surprised by the earnings reports we've seen this morning.
The bad news is deposit flight.
The entire banking system is going to see their deposits shrink.
When the Fed raises rates, things break.
You are starting to see an economic slowdown.
The U.S. regional banks, if the economy slows, are still going to find that a tricky environment.
We're going to be seeing slower growth. We're going to be seeing weakness.
And of course, that's going to hit the U.S. regional banks.
So we're just watching to see what else could potentially come under pressure.
Let's get you the latest. We can do that now with Bloomberg's Shonali Basak. Hey, Shonali.
John, if the problem of yesterday was deposit flight, the problem of tomorrow will be net interest income. You're looking at the banks of yesterday give up some of the gains. You're looking at a lot of banks trading more weakly in the market today. The reason being you have firms like Zions, for example, missing on net interest income. Same with Comerica missing on deposits as well as net interest income. You have the likes of Fifth Third also saying that net interest income will be lower in the next quarter. And really, the question here is, if they're not lending, where does the lending come from? Is this a wholesale contraction here in the credit markets? If you look at the commentary, it's quite concerning to hear how many banks are talking about the risk aversion that they're seeing in the market. Some of these banks that you're seeing on the screen here are more heavily weighted to commercial real estate. Think the Comerica and Zions of the world here. But again, you even see some of the bigger regionals giving up some of their gains from yesterday. Fifth Third, Truist as well. Deposits are flat from where they were before, and even with them beating expectations, the question is quickly turning to profitability of these banks.
Shanali, can we draw some conclusions? I know we have First Republic on Monday. What's left that still needs to come?
Yeah, First Republic is the big whale in the room, although we have more regionals, a slew of them really into next week. The question is First Republic truly stable, and will they be stable throughout the entirety of the next quarter as well? Listen, one really interesting thing, John, that I'm hearing in the market here, I talked to a lot of bond traders last night because some of these bonds recovered as well as the stocks, and there were a lot of cautionary tales still drawn among large credit managers among whether you get into the bonds at these levels. It's interesting. You recovered on First Western Alliance from 56 cents on the dollar to 80 cents. And the worry here is, are you safe at that level?
Let's talk to a man who knows a little something about the bond market. Shanali, thank you. We can do that with Mohammed Al-Erin of Queen's College, Cambridge. He joins us through the hour. Mohammed, co-hosting, anchoring, whatever you want to call it. Good morning to you, sir.
Thanks for having me.
Thank you for being with us. Last Friday, you said to me, slam the table at the IMF World Bank meetings, very aggressive. You said it's not a banking crisis. And you were right, in many ways, it's not. I want to know, though, is it the beginning of a credit crunch? Would you go that far?
So I don't remember slamming the table, but I remember saying, can we stop calling it a crisis? This is not a crisis. It was tremors. I will disappoint you by saying this is not a credit crunch, this is a credit contraction. And there is a difference. A credit crunch is economy-wide, it has massive implication. A credit contraction has distributional effects. So we should be talking about the distributional effects, that's issue number one, and unfortunately that's going to hit small businesses harder than big business. And then the second issue we should be talking about is what the numbers are telling us, which is certain models are incredibly pressured in a world of higher rates for longer. And that's the world we're in right now. So what these numbers are telling us in the NIMs, and then we're going to see the cost of doing business go up, and then we're going to see capital requirements go up. It's just going to be harder for those banks to operate in this environment.
It goes back to that phrase we used at the top of the hour, surviving and not thriving. A big question we've asked repeatedly over the last month, and we've all been trying to answer it. To what extent is everything that you've just described a substitute for rate hikes at a Federal Reserve? Can you draw conclusions on that just yet?
I think it's hard to draw. There will be some substitute, but as you know, the estimates go from 25 basis points to 200 basis points. I think 200 basis points sounds way too much. I think it's probably more in the 25 to 50. But remember, there's a time and consistency issue. This is going to play out over time, but we've got the inflation issues up front. So this is going to be, it just makes the Fed's ability to navigate this trilemma, price stability, maximum jobs, and also financial stability, that much harder.
So they've got to talk about the totality of the data, so to speak. You've got the traditional indicators, CPI, payrolls, GDP, all of that, and then you've got the banking stress. And we've been trying to work out over the last few weeks how much weight should you put on each. Would you de-emphasize the indications that you're getting from the banks right now and re-emphasize the inflation pressure that we've been so focused on for 12 months?
I think you've got to look at it holistically, John. So if you're a policymaker, you've got to look at it holistically. If you're in the marketplace, some of your emphasis on whether we're going into recession or not going into recession should shift to which business models, which business approaches are no longer viable in a world of higher rates for longer. Commercial real estate, that's going to play out. We have $1 trillion, as you know, that has to be refinanced in the next 18 months. A lot of this stuff is going to have to hit the marketplace. It's not viable. People are not going to be able to hold it. So focus much more, if you're in the marketplace, about the business approaches that are going to come under significant pressure.
As a policymaker, knowing that's on the horizon, do you have the luxury of waiting, of having some patience about all of this?
You know, if we had started early enough, and I hate saying this over and over again, if we had started early enough, we would have the ability to wait. But we're late. We know now, we have ample evidence that inflation is sticky. We have ample evidence that wage growth is still too high. So the Fed is in a box, and I can't see the Fed waiting. I mean, the big question is, what do they do after May? I'm pretty sure they're going to hike 25 basis points in May. And what do they do after that? And they have to have a strategic view. They cannot go just on data dependency.
The disinflationary process has begun, has started, was a phrase the chairman used a few times.
11 times.
Before SVB.
11 times.
It was pre-SVB in that news conference, and in his semi-annual testimony opened the door to a 50 basis point hike. Are we seeing this progress start to continue, the stuff that he identified? Are you seeing any sign of that continue? If you take the banking stress out of it, you look at PPI, look at jobless claims starting to move in the other direction. Is that progress for you?
So absolute progress on the good side. you will see disinflation on the goods side. The problem is what happens on services. And I'm focused much more on services than I am on goods. Goods will continue to disinflate to a certain level. The question is, when will services disinflate? And the evidence we have so far is they are nowhere near disinflating. They're still inflating quite robustly.
So they've got a choice, and then they've got a big risk. The choice they're going to make after May is whether they should pause or not. They've implied, based on the median dot in their dot plot, and we can talk about the range of views of the Fed, but let's work with the median for now, just for the purpose of this conversation. One more hike and wait. And you said pretty clearly, you've made it very simple, there's three scenarios here. Pause, and then you pause. You wait through the rest of this year. You pause, and then maybe you cut. Or you pause, and then maybe you have to start hiking again. Of those three right now, where are you leaning?
So I can tell you what I think the Fed will do. The Fed will hike in May, then it will pause, okay? And then we're going to have a real question as, is this an anchored Fed strategically, or is it this continues to be a flip-flopping Fed? And I hope that this Fed gets anchored. You know, my view, and Secretary Yellen's comments are going to reinforce this view, is we're living in a world of deficient aggregate supply. The supply side is not as elastic as it used to be because of geopolitical issues, because of transition issues, because of companies looking for more resilience. So if you are anchored by that view, you will take a different approach to interest rates. The Fed is not anchored by this view as yet. And that's why you see the 2-year. You know, I smiled when I saw the New York Times, of all newspapers, the New York Times talking about the bond market and calling it bonkers.
Yep.
And it has been bonkers. Look at the 2 years. Look what is, it's moving again today.
You've said this Fed is too data dependent. Is that what you're saying right now?
Excessively data dependent. It has to have a longer term view. It has to be anchored by some strategic view of the economy. Of course, it's a gamble, but without that, even cash management becomes really hard. Just, again, look at the volatility in the 2-year.
Well, the IMF's taken a view, haven't they?
They have.
They've said we're going back to the pre-pandemic world of low interest rates. Do you sense that's the Fed's view?
I don't know what the Fed's view is, and that's one of the problems. I don't know what the Fed's longer-term view is. It's interesting. I mean, Olivier Blanchard has taken the same view. You know, I am not there. I think we live in an economy that's supply pressured for the next few years. So I do not see inflation going down quickly. I do not see interest rate going down quickly. But those who simply extrapolate the past argue that this will happen.
Secretary Yellen, you mentioned those comments. Just to share that with our audience, if you are just tuning in, Secretary Yellen will talk about China at 10:15 Eastern time this morning. So around about an hour from now, this is what the Treasury Secretary's had to say in some pre-prepared remarks, just a release of this one paragraph, this one quote. National security is paramount in our relationship with China. We will not compromise on these concerns, even when they force trade-offs with economic interests. We'll build on that a little bit later in the hour. Mohammed, you're going to be sticking with us, I'm pleased to say. Let's get you some movers going into the opening bell. There are many, 20 minutes out from the opening bell. Here's Abby.
Hey, John. Well, I'm impressed that you've made it 10 minutes without talking about Tesla, but let's take a look at the shares of Tesla because they are, of course, dropping in the pre-market on a disappointing quarter. Profits were down 24%. This is as the company has reduced prices on its vehicles to spur volume demand. Margins hit, investors not liking it. Right now at pre-market session lows, down 8.7%. But it's not just Tesla weighing on the markets today, and it's not just the banks. We will take a look at some of the banks, but first, AT&T heading to its worst day since, I believe, July of last year. Free cash flow of $1 billion was light of the $3 billion estimate, but I think it's really the moderation of growth in their wireless segment comments that are spurring the weakness here. And then taking a look at the banks, Zion down 5%. This, of course, as deposits are moving in the wrong direction, both sequentially and year over year. And Key, their first quarter revenues missed. They've cut the fiscal year net interest income. These regional banks getting a bit hit today, John.
Abby, thanks for that. We'll stay on top of it going into the opening bell. Coming up on this program, a rush of Fed speak before the quiet period.
A bunch of Fed speak coming out, probably hinting towards one and done, which is our view, as opposed to, okay, well, the economy is now taking a second spot to political relations coming from the Treasury Secretary. There's a lot of confusion.
Waller, Mester, Bowman, Bostic, Harker, all on deck. That conversation coming up shortly. And later, SpaceX, once again attempting to launch its Starship rocket. We'll go there live as it happens.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The Fed obviously can raise short rates to whatever level they want to get to, but the more they raise rates, then they're going to have to defend that position and stay on hold for even longer. So that the more they hike, they're going to have to try to at least maintain a position, because why cut 2 months, 3 months later, right? I do think the data will get weaker into the summer and into the fall, and so they're going to be faced with defending why they raised to begin with these last few hikes, as well as staying on hold at 5+%, which could then start to expose further weakness.
Fed officials dominated the calendar this week, delivering one message: the central bank isn't done hiking. New York Fed President John Williams weighing in on that. Inflation is still too high, and we will use our monetary policy tools to restore price stability. The May meeting now less than 2 weeks away, and it's a big final round of Fed speak. Today and into the quiet period, we'll hear from Waller Mester, Bowman Logan, Bostic Harker, and Cook as well. Mike McKee, what a lineup.
It's murderer's row, as they used to say about Yankee Stadium. And I'll go back in time and say that John Williams is basically the E.F. Hutton of the Fed. The guy sitting next to you will know what I mean, certainly, because he's one of the top 3 Fed officials, and we're missing the second one, the vice chairman at the moment. So what he says is probably where Jay Powell is. And where they are is looking to raise rates one more time in May, 25 basis points. You can see the odds there. They've gone up to 90% for a quarter point move on May 3rd, which means the question now is what happens next after this? We go from what now to what's next, because the Fed doesn't really know what it's going to do. There's all kinds of various interpretations of where we are, except that there's a kind of unanimity about one thing. I mean, the Beige Book shows slowing economy and slowing inflation, but Fed officials this week are all emphasizing the fact that inflation is still too high. They probably could raise rates again if it continues that way, but there are risks to that. The full impact of Fed tightening hasn't hit. There is the possibility of a bank credit crunch, and the debt ceiling now becomes more of an issue. Show this to you, and I know we'll talk about it later, John, but the Treasury cash balance not as high as they want it to be, pulls forward when the Fed has to start thinking about what it's going to do.
Mike McKee, we're going to return to that a little bit later, as you indicate. In about 20 minutes' time, we'll catch up with Anne-Marie and Mike McKee on that topic. Joining us now, Morgan Stanley's Brian Weinstein, Mona Mahajan of Edward Jones. Mohammed's still with us, I'm pleased to say. Mona, I want to come to you. Based on what we've learned from Shanali this morning and all the banks, regional, small and large, over the last week or so, how do you think that's going to inform the Federal Reserve in early May?
Yeah, it's an interesting question. And in fact, coming into earnings season, I think there was a lot of concern that we'd get much worse news on the banking front, whether it was large banks or the regional banks. And in fact, we've kind of gone through this last week and a half pretty unscathed here. Yes, there has been a little bit of deposit flight, especially from the regionals to the larger banks. But in fact, both large and regional banks have reiterated the message that, one, the consumer is pretty healthy. Two, there is no systemic risk really to the system that's imminent. And from a Fed perspective, really that probably does help them reiterate the message we've been hearing all this week and probably will continue to hear today, that they need to continue on this inflation battle. So I think certainly the Fed has two sets of tools that it can deploy if it needs to. It has its liquidity tools to address any potential banking crisis, but it also uses its monetary policy tool really to address the inflation issue. And I do think the 25 basis points that the market is essentially giving the Fed will take it, raise rates to that 5.25%. And from there, I do think they'll take some time to assess both the economy and the inflation situation going forward.
Moina, given what you just said about the uncertainty about what the Fed may do, the uncertainty about the economy, the different messages we're getting from the banking system, how do we reconcile all this with a VIX at 17? And normally we'd expect the VIX at 17 to be pushing more funds into risk assets. Have we seen that already, or are we yet to see this?
Yeah, it's a great point, Mohammed. We've been watching this VIX carefully as well. It's almost indicating a bit of complacency in the markets. And, you know, what I'd say is generally the markets had been anticipating a few big catalysts that maybe have underwhelmed. So the first was earnings season, and certainly it's early days still, but markets were really looking at, you know, potentially a negative 7.5% year-on-year earnings growth for the first quarter. Looks like thus far numbers are coming in much better than that, probably still looking at a negative 6.5% quarter or so, but earnings thus far have been a positive surprise. The second big catalyst was going to be this May Fed meeting, and in fact, looks like markets and the Fed may be converging toward this 25 basis point rate hike. There really has not been any meaningful indication one way or the other, and in fact, when we think about the economy broadly, markets are anticipating, it's, you know, kind of the worst kept secret out there, that we are heading towards perhaps a period of economic downturn, this mild recession that we've all been talking about. And so thus far, I think this complacency we've seen in the market is because we haven't hit any catalyst that would meaningfully deviate from market expectations.
Taking comfort from rate cuts and pricing them in too. Brian, I think that's the issue right now, and I wonder how you reconcile it. Markets priced in cuts and rallied. Can we price out rate cuts, and can risk assets rally still?
I think it's going to be difficult to price out rate cuts because, listen, what I think is bonkers was a 5% two-year note, right? I don't see any evidence that the Fed can or wants to stay up there. I think Mohammed said this very well. What are their indicators? What are we looking at? It can't be next month's CPI and next month's, you know, non-farm payroll number. So you look at this recession, which is in the Fed forecasts and in the staff forecasts. So to raise rates one more time, fine. You're tinkering now. There's no, you know, there's no science behind 5 versus 5.25. What they're trying to do is go a little too high to prove a point, let the economy soften and come back down. So if I could lock in 5% for 2 years again, I would do it. We're locking in 4.20. I don't think it's a crazy level, and I think there are eases out there. I don't think know why. So is it good for risk assets? Not in the way they want it to be. I don't think it's a smooth transition.
Brian, I talked to Mohammed moments ago about whether this Fed had the luxury of being patient, waiting. When they start to wait, or at least want to signal they're going to wait and pause, they often start talking about long and variable lags. You expected to hear more of that, Brian?
I expect to hear that phrase a lot, and I think it's accurate, right? We've had a very, very steep rate hiking cycle, albeit a little bit too late, no question about that. So they need credibility. But listen, I don't see anywhere in the bond market where the credibility is being questioned. Long-term break-evens look like the old regime, right? There's no inflation risk priced into the market. So the Fed seems to have won that battle for now. The idea that they can control the economy, ease a little bit, and keep risk assets together, maybe they can or can't, but the market seems to trust them. High yield looks okay, maybe loans look a little bit cheap, but I think they have a lot more credibility now than we talk about, you know, outwardly, given what the market's pricing in. So that's where I come out on the topic.
So Brian, how do you reconcile in your mind long and variable lags with being highly data dependent? Highly data dependent suggests you react to whatever data is today. Long and variable lag implies that you really should be having a view on what the data is going to be in 9 to 18 months. How do you reconcile that?
Yeah. I can't. I'm just as surprised as you that they haven't moved away, that the dialogue hasn't changed, that they're focusing the market on things that are really lagging indicators, right? Owner's equivalent rent. Well, we can look at better indicators for rent. We don't need to look at next month's CPI to figure out that rental inflation has slowed down. You know, service inflation, as you point out, is even harder to look at. So I think they have to change what they're looking at. I'm surprised it hasn't happened yet. And I'm surprised we haven't heard long and variable lags with an indicator pointing at something else. And hopefully it's coming, Mohammed. I don't see how we can continue to to play this short-term data game, given we need to sit at 5% or 5.25% for a little while.
Mona, final word goes to you. Do you expect the Federal Reserve to abandon what Brian just called that short-term data game?
You know, it seems like they will stick with that language of data dependent, but I do agree that they could start adding some indicators that do show more real-time indications. To Brian's point, housing and rental, it is lagged in the CPI data. There are more real-time indicators that are better. Even the labor market, it is a lagging indicator, not usually the first shoe to drop, usually the last shoe to drop. And so looking at, that wage growth component, there may be more real-time data, including jobless claims that they can point to. So certainly data dependent will stay in the language, but I do think that they have to start thinking about what's coming ahead in terms of this economic downturn.
Mona, Brian, thank you, as always. Mohammed, a lot of people on your page on this one at the moment. This is a big topic for you, isn't it?
It is. I think it's really important to give the market some sort of strategic anchoring. Otherwise, we are going to continue this dance, and it hurts. This volatility ends up breaking things.
Well, it's breaking the bond market in some ways, based on the volatility of the 2-year over the last month. Coming up on this program, the morning calls, and later, sounding the alarm on Tesla's price cuts. Why Wedbush's Dan Ives thinks softer margins will continue weighing on shares. That conversation coming up. Plus, just minutes away from SpaceX attempting to launch its Starship rocket once again.
Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Away from the opening bell, equity futures deeply negative through most of this morning. On the S&P 500 down 0.7%. On the Nasdaq down 0.9%. Let's get you some morning calls. Truist first up, downgrading TripAdvisor to hold ahead of earnings, expecting a softer macroeconomic backdrop to weigh on lodging stocks. That stock is down 3.4%. Jefferies upgrading GE to buy, growing increasingly optimistic about the company's aerospace business. And finally, Wedbush cutting its Tesla price target down to $215 after earnings, expecting margins to remain an overhang for the next few quarters. That stock is down by 8%. I have to say, Elon Musk this morning is not going to be looking at that. He's going to be looking at this. Another company, SpaceX, once again attempting to launch its next-generation Starship rocket after scrapping its first attempt on Monday. Ed Ludlow joins us now with more. Good morning to you, Ed.
Jonathan, £10 million of propellant have been loaded into the Starship system. If we clear the launch pad, this will be the most powerful, largest rocket launch system to attempt to go into orbit. 16.7 million pounds of thrust force generated, double what Saturn V achieved. And remember, Saturn V took man around the moon in 1968. This is the level and scale that we are talking about. 2 stages. The Super Heavy booster has never been launched, never been tested. The spacecraft, which sits on top, the shiny bit, has been tested 9 times, only landed after a high altitude test successfully once. So there is a lot at stake here. The bar for SpaceX in terms of what success looks like, though, is very low. They want the data. At a minimum, they hope they clear the launch pad. But what they want to do is generate data from the engines, from the 33 Raptor engines, hopefully at the 3-minute mark have the 2 stages separate, but there will be no attempt either way to recover either the Super Heavy booster, which is destined to fall into the Gulf of Mexico, and the spacecraft will hopefully orbit at around 150 to 250 kilometers above Earth for about an hour, come back down into Earth's atmosphere, and then splash down off the coast of Hawaii. Data, 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 but it's an expensive exercise, Jonathan.
Ed, how long before this takes off? What time is this launch?
This launch, we hope, is happening in the next 2 minutes. I actually have to defer to you, John, because I've got a tiny screen in front of me. So if you tell me what's left on the clock, we'll go from there.
I think it's got to be holding at the moment. Let's just look at the data. I haven't got the time either. Ed, you stay close,
I see the
Ed.
hold now.
We've got a hold?
I see the hold, Jonathan.
We've got a hold,
yeah.
Okay. Ed, what do you think that means based on that hold? Is that anything to be concerned about?
There are 2 windows for a hold. At the 6-minute mark, on most SpaceX launch systems, they allow teams that are not running in synchronicity to align with each other. There's often a second opportunity at the 40-second mark where they say, let's take a hold, look at the systems. It can be anything from various teams managing the launch running out of sync, to the onboard computers detecting an error. I don't know what it is in this instance, but it's quite normal. So let's leave it. We can come back, and we're all hoping this actually goes ahead.
Ed, the launch window, just how big is that?
The launch window is 150 minutes, and remember that because of the air clearance required to do this, SpaceX is at the whim of the FAA. They have to manage airplanes, right, flying in and around the South Texas area, so there's a clear 150-minute window. It's normal for minute-by-minute delays. Remember when you and I were on television earlier in the week, they kicked it by an hour, then they kicked it by 20 minutes, and then they kicked it altogether due to a frozen pressurant valve, so anything could happen.
Ed, thank you, sir. We're going to come back to you a little bit later and return to those pictures if we do get another attempt at this. Another big step, of course, to taking people to the moon and beyond, and maybe even to Mars. Let's deal with the price action now. We're down about 0.8% on the S&P 500. On the Nasdaq, we're down 1 full percentage point. Equity futures are a whole lot lower. That's the opening bell. Let's get straight to the bond market. Yields look like this in the Treasury market. Your 10-year yield down 5 basis points, 353.94 in the FX market. Euro dollar firmer by 0.1%, 109.68. The big sector to watch at the opening bell, the financials. A host of regional banks reporting results after recording their best day of gains in a month on Wednesday. Shanali Basak has more. Hey, Shanali.
John, you have to take a look at the decline you're seeing already because you have KeyCorp, which is declining pretty significantly at the open here. Net interest income was not only below expectations, they're also saying when they previously expected an increase of this year, they are now expecting a decline. And you could take a look at it's one of the biggest decliners on the day. Something interesting to ask, a lot of your guests have been talking about the risks that are not baked into the market. If you look, provisions at a lot of these banks, provisions for loan losses have been ticking slightly higher, and they're higher than a lot of what estimates show on Wall Street. I looked ahead for you over the next couple of quarters also. They're expected to continue to increase into the year, except by not that much. If economic conditions deteriorate, then do those conditions become a bigger problem for these banks? I even want to point out American Express here because it's declining at the open, and they tend to have a wealthier clientele. The provisions for loan losses there topped $1 billion. That was well over what analysts were expecting. So are we quickly turning to how quickly credit can start to deteriorate here, even if you're thinking it doesn't fall into danger territory? Is the market not baking in the risk that it could really weigh on these banks in a bigger way at a time where you're also seeing the shift in funding mix as deposits continue to be under pressure?
Shanali, thank you. Let's stick with the earnings and move away from the financials and get to Tesla. That's been a big mover this morning. Price target cuts from the street rolling in. just as fast as the company's own price cuts as concerns over margins grow. Abby has more on this one. Abby, this one's sinking all morning.
It certainly is. It's in fact having its worst day right now since January 3rd. And if you recall, at that time, the stock was around $100, really with no floor in sight. And then support kicked in. But today, not so much. The 47% year-to-date rally into today, a big chunk coming out of it. It has everything to do with what you were just talking about, concerns around margins. Margins being hit by about 200 basis points on the quarter, going below 20%. This, of course, has to do with the fact that they are lowering prices between 15 to 30% on the various models, especially for the Model Y, closer to 30%, the Model S the least. And the question is, how much will this impact numbers going forward? They're making these cuts so that they can keep demand in place. Volume, it is likely, they're suggesting that volumes will stick around 1.8 million cars delivered this year. But right now, it seems that investors want both. They want the volumes and they want it to done so that margins aren't destroyed. Again, Tesla shares down about 8%, the worst day in about 3 months.
The broader market down about 0.7%. Abby, thanks for that. Dan Ives of Wedbush cutting his price target on Tesla to 215, saying this: with no rose-colored glasses, margins are now a delicate issue that are keeping Tesla investors up at night. Dan, I'm pleased to say, joins us right now. Dan, did it keep you up at night?
A little. I mean, I think, 20% margins was really the threshold. They came in underneath that, and I think that's really going to be why the stock's down here. This is not what the street want to see from a margin perspective.
Well, we've got another launch elsewhere taking Elon Musk's attention. And this is it right now, a crucial step in the goal of taking humans to the moon and Mars. SpaceX attempting another launch.
Jonathan, we have liftoff. Starship, Super Heavy booster, and Starship spacecraft have cleared the launch pad. What you see on your screen is the most powerful launch system developed by mankind, heading out of Earth's atmosphere. 16.7 million pounds of thrust generated by the 33 Raptor engines at the base of the Super Heavy booster. 55-second mark, we hit max Q, the moment of the maximum aerodynamic stress or pressure on the rocket, working towards a top speed in orbital speeds of 17,500 miles per hour. This is unprecedented, Jonathan, what you're seeing on your screen. Remember, the goal here was very simple. Clear the launch tower, clear the pad. At the 3-minute mark, we expect the two stages, the Super Heavy booster and the Starship spacecraft, to separate from one another. The Super Heavy booster will then fall back down to Earth and splash down into the Gulf of Mexico, where it will sink. There will be no attempt to recover the Super Heavy booster. Starship, the spacecraft, will arc towards Hawaii and travel at an orbital height of 150 to 250 kilometers above the Earth for about an hour, perform a maneuver burn to come back into Earth's atmosphere, and then splash down 140 miles from the coast of Hawaii, 250 kilometers. They will not attempt to recover it. Jonathan Ferro in New York, Mohammed Al-Arian as well. I don't know how to make this a confluence between markets, economics, and the future of mankind, but all I'll say is this is a ginormous moment for the space industry. And once again, Elon Musk has done what he said he'd do, later than he said he would, and broken a barrier when it comes to what's technologically possible for the space industry.
Ed, stay close. We'll keep running these pictures and follow this as it evolves. Dan Ives, I want to bring you back in. Elon Musk, Dan, never mind Tesla. Can you talk about this for a moment? What an effort by that man.
Look, I mean, incredible, and I think what he's done with Tesla, with SpaceX, just continues to sort of be the gold standard. And I think that's something that ultimately he's in this position of strength. And for Tesla, that's why it's also, you see with earnings, it's held to a higher standard because of what Musk has created.
We're going to return to those pictures in a moment, Dan. And for those of you at home following this, you can carry on following it in those pictures on the screen right now. But Dan, you and I need to talk about Tesla. That stock is lower. Margins are an issue. Is it keeping you up at night, Dan? You mentioned in your notes that it might keep Tesla investors up at night. Is it something that you're concerned about? And I think what everyone wants to know, Dan, you're so bullish on this company, on the leadership from Elon Musk. We all want to know what would change your mind.
Yeah, look, I think it was a concern, no doubt. I mean, no rose-colored glasses, that it came under 20%. Now, look, right now they're going on the aggressive, going after market share, and I think that's the smart strategic poker move. But I do believe the next few quarters are going to be pivotal in terms of trying to keep margins around here. If you have more price cuts and this just continues to go down from a margin perspective, I think that would be a clear negative going forward. And that's why the stock's down here.
So Dan, think of Amazon early on, where the strategy was dominate, 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 put up barriers to entry to others. Would that work here? Will we look back and think that this was a smart strategic move, or we will look back and think that this was silly, that you can't dominate this market?
Yeah, Mohammed, I think it's a great question. I think here they're essentially putting an iron fence around their install base. It's an EV arms race that's playing out across the board. And, you know, it's hard to argue with Musk. I mean, essentially, Musk has been playing, you know, he's been playing chess, others have been playing checkers. And I think what we're seeing here, it's the right strategic move for the long term, but in the near term, it's a rip the Band-Aid off moment. And this is going to be transitory, what we see with margins.
Let's just build on that a moment, Dan, and talk about multiples. What I want to buy when I have a name like this with a multiple like this one is a high-growth, high-margin business, not an EV arms race. Dan, does that not resonate with you at all?
Oh, look, it definitely does in the near term. I think if we sit here a year and a half, 2 years from now, and this continues to be the narrative, then no doubt. I mean, this will be a major problem from a multiple and from where the stock is. But I do believe that this is sort of a pivotal time, given the macro, to really go on the offensive, cut prices, and make sure in this sort of arms race that they put that what I'll call an iron fence around the install base. Because it is an important moment. It's almost a moment of truth for Tesla. And investors really are going to now have to navigate what margins look like the next 1, 2, 3 quarters.
Just want to get an update on that attempt from SpaceX, from Ed Ludlow on the West Coast. Ed, what have you got?
Not a completely successful mission, Jonathan. We were tracking at the 3-minute mark for the Starship spacecraft to separate from the Super Heavy booster. That did not happen. Basically, the full stack remained connected, and once it reached a certain height, the combined Super Heavy booster and Starship spacecraft started falling back down to Earth, rotating in midair. At some point, an explosion was visible at high altitude while the combined Starship system fell back down to Earth. In other words, it just didn't separate. But remember, you could see on your screen at one point SpaceX employees cheering, because simply clearing the launch pad is regarded as a high degree of success for SpaceX. This mission all about gathering data. This is just the start of taking Starship from a developmental system to an operational system. So we will hear more about the technical reasons why, but we got to a certain height, the thing didn't separate the 2 stages, and then it blew up. But my goodness, that was fun.
To your point, Ed, how do we define success today? And Elon Musk himself lowered the bar quite a lot over the last couple of days, didn't he?
Yeah, you'll remember that on Sunday night, he did a Twitter Spaces for subscribers only, where he just continually hammered that point. It may not happen at all, and even if it does, the principal concern was any damage to the launch pad or stage 0, because the launch pad is an essential part of the launch system. It might not be the rocket itself, but it is highly technical and expensive to develop. They cleared the pad. There wasn't any standing damage, so that in itself is a success. But the fact that they were able to get to such high altitude but not have stage separation, they will simply take the data generated, work out what went wrong. And what we're hearing from SpaceX is that allows them to plan a cadence of next attempts. We are still some way away, John, from this being sort of meaningfully operational, either carrying Starlink satellites into orbit or humans, which is destined for the back end of 2024 and beyond.
It's the first step of a much bigger, broader effort. Appreciate it, Ed, as always, and looking forward to the program a little bit later this morning, or rather this afternoon, midday, the Tech Show. Bloomberg Technology, Caroline Hyde, Ed Ludlow. Looking forward to that. Dan, I just want to squeeze in one question to you, and then I'm going to wrap things up with Mohammed. Dan Ives, we talked about margins. What on earth is going on with inventory? Why would that be ticking higher as they're cutting prices?
Well, look, I think that is definitely a question that we see in the U.S. I do think China is really where demand is starting to tick up. And that's what I view in the next month or two. That inventory is ultimately going to come down. The price cuts have sort of stabilized. And that's why in 2Q and 3Q, That's what I view as sort of an inflection point in terms of where this volume margin story starts to take the next level.
Dan, appreciate it, sir. Dan Ives of Wedbush.
Thank
Still
you.
bullish on the name, but just bringing in that price target a little bit. Mohammed, great to have you with us this morning.
Thanks so much for having me.
A final word. What are you focused on now going into May 3rd with this Fed?
I'm just focusing on the narrative as to what happens after May 3rd and whether they can convince the market that their forward policy guidance is credible. You know, they've been pretty consistent on telling us what happens after May 3rd, which is very little. We're going to stay there. The market and all the narrative is that's not going to happen. We've got to have these two things converge one way or the other.
Well, the data and time will take care of that at some point. Mohammed, fantastic to catch up with you, sir, as always. Mohammed Al-Arian. Coming up on this program, Secretary Yellen preparing to deliver remarks on China economic ties.
We believe that it is an important bilateral relationship, the U.S.-China relationship, even as we're talking about strategic competition.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We believe it's important to maintain open lines of communication with China. We believe that it is an important bilateral relationship, the U.S.-China relationship, even as we're talking about strategic competition with China. And so that has not changed. We're going to continue to move forward in that way.
Secretary Yellen taking a spotlight in Washington, delivering a speech at 10:15 Eastern Time on economic times with China. writing in a prepared remarks the following: national security is of paramount importance in our relationship with the country. We will not compromise on these concerns, even when they force trade-offs with our economic interests. AMH joins us now in Washington. Morning, Anne-Marie.
Good morning, John. Well, I think what we're going to hear from Secretary Yellen is she's going to make very clear that regardless, national security interests are number one, even if it means it wouldn't be the best decision, say, if you were an economist. That's the thing she's going to outline today. National security interests are paramount. She's also going to talk about really a more level playing field when it comes to the economies of Beijing and Washington, that she wants to set better guardrails when it comes to that economic relationship. And third, areas where you heard Karine Jean-Pierre, the president's press secretary, talk about where to engage. And on that, it's going to be climate change and also debt sustainability. And already, Jonathan, we're seeing this administration try to take a warmer tone on opening up an avenue for engagement. We saw that from Secretary of State Blinken at the G7 foreign ministers meeting in Japan. Also today, we have U.S. Ambassador to China having one of his first meetings with a senior U.S. official since February. So you could see potentially Secretary Yellen here is setting up for her own trip to Beijing.
AMH, and also I'd say this, just given who we're talking about here, the former Federal Reserve chair, we're seeing this Treasury Secretary transform into someone who is willing to put politics before economics.
Well, I don't think the Treasury Secretary would call national security interest politics, but to your point, and I really go back to the tension in the administration when inflation was very high last year, and they had a decision on their desk, and that was whether to ease some of the Trump-era tariffs or keep them, double down, because of national security concerns and that leverage that those tariffs still would provide. And at the end of the day, the administration went with national security concerns, and Janet Yellen is coming out today, and she's backing that.
AMH, thanks for that. That's the latest from Washington. Just getting that headline that we can confirm, that we all basically saw, that SpaceX Starship exploded after a failed rocket separation. Ed Ludlow's going to cover that for you a little bit later. Also happening in Washington, the debt ceiling debate heating up, and it's the president versus the speaker.
MAGA Republicans in Congress are threatening to default on the national debt. They say they're going to default unless I agree to all these wacko notions they have. America is not a deadbeat nation. We meet our obligations.
Today, I'm proud to announce that we are introducing the Limit, Save, Grow Act of 2023. President Biden has a choice. Come to the table and stop playing partisan political games. Or cover his ears, refuse to negotiate, and risk bumbling his way into the first default in our nation's history.
Back with us, Mike McKee. Mike, we need to talk about this, don't we? I think we're all trying to gauge, based on the returns, the tax returns of the last week or so, where that ex-date might fall. Mike, where is it?
Well, right now it is at the beginning of June, and you know, John, there's an old saying in Washington that you shouldn't watch the sausage being made, but what happens if the sausage doesn't get made? That's the job for the Treasury and the Fed. Treasury keeping a closed mouth on what it would do, but for the Fed, we have some ideas looking back at what they had done in the past. Now, you see in the markets already some kinds of reaction. We got only $108 billion in tax money on Tuesday when it was tax day. The analysts I'd spoken to said we needed somewhere between 150 and 200 billion. And so if we don't get enough in the next couple of days, it looks like we're going to move up the date for what is going to happen. And markets are already reacting to that. There's a big kink in the yield curve now with rates at the 1 month level way down, because everybody wants in on that because you know you'll get paid. But then you go farther out on the curve and they rise significantly because people don't want those securities because they might be disrupted. What is the Fed's going to do about it? They're going to have to discuss that probably at the May 3rd meeting if we are pulling forward the date of the possible default. And they, in 2013, John, met and discussed a number of different ideas, including repos, reverse repos, ways to basically keep the system going. They want to make sure that people realize that what they're talking about is keeping the Treasury market open, not helping the government fund its debts.
Mike, just one more thing on tax day. There was a delay for California. They got an extension. Do you think that plays into some of the smaller than expected numbers that we've had?
It probably does, because the 108 billion came in much lower than people had anticipated. The thought was 150 wouldn't be a very good number. So we're obviously missing a lot of money, but would California make up $50 billion? Probably not. So unless we get some additional cash coming in, and there will be some over the next few days, then the date moves up. The question is, can they last until June 15th when quarterly tax payments come in, and that would maybe push it out till August. But right now, it's beginning to look like you got to take the 1st of June seriously.
Mike, thank you, mate. 1st of June. I wonder when this market starts to carry in a bigger way. Mike McKee there on the latest. Your broader market right now, 22 minutes into the session, negative 0.6% on the S&P and the Nasdaq, down 0.5%. In the broader bond market, yields are lower off the back of jobless claims data earlier. We're down 7 basis points on a 2-year to 4.17. On a 10-year, we are down to about 3.54. We're down 5 basis points there. Let's get you some sector price action. Here's Abby.
John, well, what's really amazing here is that 0.6% decline. It's the worst day in about a month. It really speaks to the slow melt-up that we've had. Not surprisingly, then, with this sort of a decline, we have most sectors, all sectors at this point, lower. Utilities down the least, that defensive sector, energy and consumer discretionary down the most, down about 1% or more. Banks in the middle, down 0.4%. On the year, though, it's all about consumer discretionary being higher, a piece of that being Tesla, which of course is down today, but higher on the year. The banks, though, down 16%, a real divergence there between tech and the financials.
Bit of weakness this morning at the surface level, at the index level. Abby, thanks for that. More broadly, we're down by about 5 or 0.6% on the S&P. Up next, your trading diary, a ton of Fed speak to round out the week.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
25 minutes into the session, equities lower by 0.6% on the S&P. On the Nasdaq, recovering just a little bit. We're down 0.5%. That's the price action. Here's the trading diary, 10:15 Eastern. 20 minutes from now, we'll hear from the Secretary of the Treasury, Janet Yellen, on US-China relations, plus Fed speak, Waller, Mester, Bowman, Logan, Bostic, Harker throughout the day. Rounding out the week with US PMIs on Friday, going into the quiet period for the Federal Reserve. Looking out to next week, more earnings on deck. First Republic on Monday, followed by Alphabet and Microsoft on Tuesday. On Thursday, Amazon and Intel report, and we get another US GDP report. report. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed, and he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, They claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off.